Kingdom Aviation since the first runway was put in at Heathrow 400 years ago. He joins us now, our European aviation editor. Chris, you have more experience than anybody at Bloomberg on this. What will you observe among UK transportation today?
We are in an extreme situation of potential lockdown of the whole of the UK border with the outside world if things carry on as they are. We had the announcement in London by Boris Johnson of the new Tier 4 restrictions in response to the new strain of the virus, and then European nations have reacted to that Sunday and then again further today by effectively closing the border to outbound traffic from the UK so that the new strain of the virus isn't brought into those countries. That's had a huge effect on airlines. Heathrow Airport, which is already operating a hugely reduced capacity, had to cancel 22 flights in the first 3 hours this morning. Effectively everything going out to France, to the Netherlands, to Germany and a raft of other countries. And then perhaps more worryingly in terms of the wider economy, the channel ports have been shut down. Dover in particular, which is the biggest sort of freight lifeline for the entire country, has been closed. Trucks cannot leave for continental Europe, and that means that although some are still being allowed in at the moment, most likely they will decline to enter the UK because they won't be able to get home again. So there is the...
Well, this is the concern, Chris. I mean, it's not just people visiting families over Christmas. This is potential food crisis. This is a potential issue of people getting medications. How close are we to people feeling the brunt of this in terms of what they see on the shelves in the grocery store or what they can get when they go to the doctor's office?
Yeah, it depends how long this goes on for. If some sort of solution is found, which could include COVID testing, in Dover for truck drivers, then the situation might ease. There is concern brewing at the moment. We are not yet seeing panic buying, partly because people have already stocked up for the holidays and also in advance of the no-deal deadline, of course, at the end of this month. So there's been a lot of emergency stocking going on anyway. But even so, we've had 9,000 trucks going through Dover on one day last week alone. So if those are sort of strangled off for 2, 3, 4 days or more, or into the new year, perish the thought, then Britain is really going to struggle, and we're going to see serious shortages kicking in.
Chris Jasper, too short a time. Thank you so much, and particularly thank you for the exhaustive coverage this weekend of what we're seeing in the United Kingdom. He is a labor leader. He is a defense lawyer and prosecutor. Let us listen to Sir Keir.
That sees devolution as a means to an end, to empower, to democratize, and to deliver social justice. The challenge for Labour now is how to carry on that tradition, to renew the case for devolution, and to harness the energy, dynamism, and creativity.
se logra una sonrisa de parte de cada persona que utiliza el dispositivo, ya que se pone en situación, entre comillas, de una persona discapacitada. Y ven que lo sorteamos de una forma agradable, porque el simple hecho de sentarse en un dispositivo ya es agradable.
Nace MAT como una solución de movilidad a personas con discapacidad. Nace Mandados como una opción de generación de ingresos y nace MAT Tools como generación de ingresos y educación a las demás personas que no están en silla.
Surveillance. Good morning, everyone. Lisa Bramwitz and Tom Keene. We're watching the markets. Futures negative 80. They were negative 100 about 30 minutes ago. A 2% moved lower on SPX. A VIX out to a 31-ish level, 29.44 right now. With all the usual correlations you'd expect. Oil in, gold drops like a rock down $10, 18.79. And yields come in. Of most important to me, the 2-year yield, 0.1089 moments ago, is really a lower yield as 2-year notes are bid even off of what Chairman Powell is doing. Right now, our Kevin Cirilli joins us, our chief Washington correspondent, and I'm supposed to ask piercing questions about a $900 billion stimulus plan. Except it doesn't matter. It was an extraordinary weekend in the history of the nation, starting in the Oval Office on Friday, where Rudy Giuliani was a voice of reason. Kevin, we have come to an extraordinary point. The Hill advances it moments ago with McConnell worried about a floor vote in January, where the president, I'm not going to say is thinking of, but is listening to counsel speaking of things like martial law and coup. How does your Washington digest this morning?
Based upon the public comments over the weekend from people like Senator Mitt Romney, for example, the president's reported meetings are not being met with a positive reception amongst those who, quite frankly, are much more focused on getting the vaccine out in a safe and fair way and educating the public about the importance of a vaccine. So the president's reported remarks on Friday are not being taken with serious consideration as some of his ardent supporters wish that they were.
Kevin, you know Mark Meadows very well, the North Carolinian. Mark Meadows, clearly a voice of reason within all of this. What is the task of Mr. Meadows on this Monday?
Twofold. First and foremost, to make sure that this story does not drive the conversation and silence the incredibly important work that bipartisan lawmakers are doing with regards to the stimulus, and secondly, with regards to the vaccination. You've mentioned Rudy Giuliani and Mark Meadows. Both of them are incredibly savvy politicians in their own right. They are jockeying for life after the Trump administration, and now just more than one, or now exactly at less than a month. And so they have other considerations that they are weighing as well.
Just real quick, Kevin, I'm wondering, given the fact that we do have an agreement on that $900 billion stimulus effort, when do you expect it to be signed? Are there still hurdles to be crossed, or is it basically going to be a formality when they sign off on it?
It's a formality when they sign off on it. Yesterday, I spoke with a source who is involved with regards to the airline industries, and I would note that $15 billion to reinstate payroll reimbursements just to the airlines is collectively the airline industry going to be breathing a sigh of relief this morning.
Kevin, we've got to leave it there. We're just crushed for time this morning, but we look forward to speaking to you in the coming days. Just extraordinary moment in the United Kingdom and, of course, filtering over to the U.S. and the stimulus package agreed to yesterday. On the data front, negative 80 on futures. They're better, negative 100 earlier. Lisa, the VIX was out 31 level. I can't believe I'm saying that. Well through 30, right now contained at 29.63.
Yeah, really key will be the course of this new strain of the virus. A lot of people wondering how much this pushes back the return to some sort of normalcy, and we'll get a view on that next. Joshua Sharfstein joining us, Johns Hopkins Bloomberg School of Public Health Vice Dean. Very curious to see whether we can still just wear masks and socially distance ourselves, or if we have to move toward a more stringent regime. That clearly weighing on markets this morning. From New York, Lisa Abramowitz and Tom Keene, this is Bloomberg Surveillance.
In their own right.
How have you changed as a leader since that day in 1993 when you joined Roche?
You develop over time, and it's a series of experiences which hopefully make you a better leader.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Riska Gupta with the Bloomberg First Word News. Lawmakers won't have much time to review a $900 billion economic stimulus plan that congressional leaders have agreed on. Both the House and Senate are scheduled to vote on it today. Most Americans would get a one-time $600 payment. There would be $300 a week in enhanced unemployment benefits through March. And the Paycheck Protection Program would get $284 billion. That includes forgivable loans for small businesses. U.S. officials acknowledge there will be a lengthy effort to determine the extent of a suspected Russian hack on federal agencies and private companies. Republican Senator Mitt Romney says Russia acted with impunity, and he says President Trump has a blind spot about it. The president has contradicted U.S. intelligence officials and suggested that China may be behind the cyber attack. And President Trump's campaign is turning to the Supreme Court again to challenge the election result in Pennsylvania. It's filed another long-shot appeal aimed at overturning 3 separate decisions from Pennsylvania's highest court. The Supreme Court has already rejected 2 efforts to overturn Joe Biden's victory in pivotal states. And Elon Musk has inquired about converting large transactions of Tesla's balance sheet into Bitcoin. Musk had an exchange of tweets with a prominent boost of the digital currency, Michael Saylor. Saylor urged Musk to shift U.S. dollars from the electric car maker to Bitcoin. He said Musk would be doing shareholders a $100 billion favor. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom?
Ritika, thanks so much. And on the tape, we finally have a legitimate bid to the market off the horrific bottom of 90 minutes ago. Negative 100 on SPX is now negative 80, so a better tape all in all. Right now, an important conversation after speaking to Paul Hunter of East Anglia. Joshua Sharfstein joins us from Johns Hopkins. Joshua, I want to talk about Science 101, which is variants or mutations are normal. And the messaging I see, the New York Times picking this up this morning, is pros like you are concerned but not surprised. Should we be concerned and not surprised if the United Kingdom mutation comes to America?
Yes, I think that would be fair to say. There are mutations that are happening in the virus, and some of them may have some sort of relevance to the virus and us. And this one seems to make the virus potentially more contagious. Other mutations may happen that have other effects. And it's important to keep an eye on it. It really shows the field of genetic epidemiology and why it's important. My guess is if it's really been spreading in London for quite a period of time, it's probably here somewhere. But it's, without a lot of surveillance, it's hard to know.
What is our knowledge of the vaccine and the spikes on a coronavirus? Would you suggest that we have really good knowledge of the molecular back and forth between a vaccine and the spikes of the virus?
Well, something that's important to understand is that the way the vaccine works is it uses a big part of the virus, the particular spike protein, and not just one little teeny piece of that protein. So that if there's a mutation in any particular teeny piece of the protein, it's unlikely that that's going to mean that the immune system can't respond, because the immune system is picking up all different parts of the protein as it's responding. So that's what's giving people confidence that something that makes the virus spread a little faster is not going to evade the vaccine. There would need to be an awful lot of changes to the protein in order to evade the vaccine. That is what's giving, I think, the virologists some sense of confidence that it's very unlikely that this is going to be a problem for the vaccine.
That's the better news when it comes to the variant. There's a question, though, as Paul Hunter of East Anglia was talking to us earlier. He said that given the fact that wearing masks and social distancing may not be sufficient to stave off the spread of this more contagious strain, that this could prolong the pandemic by a number of months. Do you agree with that assessment?
Well, I think it's pretty likely that social distancing and wearing masks is helpful for this variant. I mean, it doesn't have magical powers. It can't. People aren't near each other. It can't spread. So this is a moment when we have to really realize that it's both the vaccine and what we do that drives the population rate down. And as that comes down, we get to do more things in our lives. So it's, a real sign that it's not enough just to wait for the vaccine.
All right, but just even if people perhaps aren't as vigilant as they ought to be, as we have seen consistently, which is probably the reason why we are seeing the spread of the virus to such a degree in so many places around the world, how much does this change the trajectory of the pandemic and lengthen the time before we return to some sort of normalcy?
Well, I mean, I agree with the premise that it takes both of these things to make a difference. And if you have more spread because people aren't vigilant, because the strain is a little more contagious, and people, maybe they're not as excited to get the vaccine, or you don't see people getting vaccinated, as the vaccine doses become available, either of those two things can prolong the pandemic, no question about it. And so you really need both to bring the pandemic to an end as quick as possible.
Joshua, comment on what CDC is saying about the age of 75. What's magical about the age of 75 versus something younger, or for that matter, older?
Well, the CDC has a very difficult challenge trying to figure out who gets the next group of vaccines. And, the good news is within a reasonably short period of time, these distinctions won't matter because there'll be a lot more vaccine. I think they picked 75 because the rate of death is higher over 75, and they wanted to also include some critical essential workers who really have been putting themselves in harm's way for all the rest of us. So they're trying to a little bit split between the people who are at the highest risk of death and the people at the highest risk of catching it. And many of those people have chronic illnesses and have gotten seriously ill and even died. So I think, they did the best they could. I think it was a reasonable decision.
Joshua Sharfstein of Johns Hopkins, thank you so much for that. An array of perhaps a little more optimism that the vaccine will be effective. I think great question, Tom, about the magical age of 75. Then there's a question of the magical concept of an essential worker. We all want to be one, but there only are the people on the front lines and how to prioritize them.
It will be like it's been for polio and all the rest. Get the vaccine out and go, go, go. And of course, we saw the vice president and Mrs. Pence with the vaccine the other day. And Lisa, I believe the president-elect scheduled for a vaccination this morning.
Later today, indeed. Talking about go, go, go. We're looking at bank stocks next. Gerard Cassidy of RBC Capital Markets, head of U.S. Bank Equity Strategy and large cap bank analyst, taking a look at that rally that we're seeing fueled by the Fed decision on Friday. From New York, this is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is Bloomberg Surveillance live from New York. I'm Lisa Abramowitz alongside the one and only Tom Keene. Francine Lacroix is off. Really interesting decision that came on Friday, an unexpected decision by the Federal Reserve to allow banks to start buying back their shares again. Immediately, JP Morgan announced that it would start buying back about $30 billion of shares. And we could see in pre-market trading, all of the bank stocks are flying high, with Goldman Sachs rising as much as 4.9%, similar to JP Morgan as well. Joining us now, Gerard Cassidy of RBC Capital Markets. He heads up the U.S. Bank Equity Strategy and Large Cap Bank Analysis. Gerard, can you talk about how unexpected this move by the Fed was and how significant it is in terms of bank stock performance going forward?
Thank you, Lisa. It was very unexpected. The consensus view going into 2021 was that the temporary suspensions of buybacks that were implemented in the third quarter of 2020 by the Federal Reserve, that they were going to continue this into probably the middle of 2021. So for them to come out on Friday with their second stress test results and say that the banks can go back with some limitations, but go back and start buying back their stock in the first quarter of 21, that was a big surprise. And it's very positive for the banks because the banks are very well capitalized, even through these stress test results. And the banks need to use this excess capital either to acquire other banks or to give it back to shareholders. And for the big banks like JP Morgan, they're going to give it back to shareholders.
So we're looking right now, the 6 biggest U.S. banks will be able to buy back as much as $11 billion of their own shares in the first quarter of next year following this Fed decision. Gerard, what is the political risk for the banks, given the fact that we're still very much in the pandemic, we're still looking at a high unemployment rate, and we're still looking at a lot of pain on Main Street? How much of a risk is it for them from a reputational standpoint to buy back shares, to pay bigger dividends, to engage in M&A that may be considered, I don't know, perhaps generous at this moment in time?
It's an interesting question because, as we all remember, in 2008 and 2009, the banks were at the centerpiece of the problems of the financial crisis. This downturn, obviously, that's not the case. In fact, you may even argue the banks are part of the solution. And so it's certainly something that they're going to be sensitive to. But the banks are working very diligently with the government, with the Paycheck Protection Program, for example, in getting money to their customers, helping them get through these downturns. So the whole view of the banking sector this time is completely different than in 08, 09. But they need, yes, they do need to be sensitive, but they also need to be able to operate as efficiently as they can when it comes to capital management, and this is part of it.
Tell me about capital management and the idea of the digital experiment. They have learned in real time in this pandemic how to do digital, how not to do digital. How important is digital going to be out 24 months to share price appreciation?
Tom, you put your finger right on it with the digitalization. As we all know, the number of bank branches have steadily been declining. Coincidentally, when the iPhone was introduced in 2008, this pandemic is only going to accelerate that process because more customers have been forced into the digital channel. It was making great advances prior to the pandemic, but boy, it's really taken hold now. As a result, the banks are going to be more efficient and more profitable. And I think if you don't have a robust digital offering to your customers in 24 months, it'll be more challenging for those banks.
Gerard Cassidy, Santa always brings me a bank merger in his stocking. Give us one little name here. You are the expert at small banks across this nation. Give me a name.
I think one of the names people should start looking at is Provident Financial Services, PFS. It's over there in New Jersey. They merged with SB1 earlier in 2020. The combination of those two banks to us could really put forward a real opportunity for investors in the small, mid-cap space for banks.
See how he does that, folks? It's just amazing. Lisa Abramowitz is taking down notes as fast as he can.
Yeah, you get it for Christmas. That's what you get in your stocking?
Yeah,
just a little bank merger.
Gerard Cassidy, thank you so much. RBC Capital Markets. We're going to come back. Markets on the move, negative 100 on futures, an improving tape, negative 67. Stay with us. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance live from New York. I'm Lisa Abramowitz alongside Tom Keene. Francine Lacroix is on a well-deserved day off. Let us paint a narrative. The narrative is red. The narrative is negative. Suddenly people waking up to a new day, a new risk of a virus strain that seems more contagious. The question is, how long will this narrative persist and how long will it be before stimulus, before a brighter future takes over with optimism? Joining us now is Cameron Kreis, Bloomberg macro strategist. Paint the narrative for us, Cameron. What are we looking at today? Is this suddenly people waking up to the reality of now, or is this simply a blip of people trying to reduce some of those extended positions ahead of year end?
Yeah, I think it's kind of a cocktail of a number of things. You've kind of got sell the fact dynamics at work with the congressional stimulus and, say, Tesla's S&P entry. You've got the same old from Brexit, which is no one knows what the state of play is going to be in 2 weeks, and it looks like it's being mismanaged. And then you've got something out of a sort of a headline out of a science fiction movie. You know, virus mutates and becomes more spreadable with a higher R naught. I think the thing is that particularly the latter headline is forcing markets to confront something that's not in their wheelhouse. Most of us are not epidemiologists. Most people probably don't know that viruses mutate all the time. And that's actually one of the ways that epidemiologists are able to track different vectors of infection. Obviously, the issue now is that it is more virulent in terms of its spreadability. It's prompted some significant policies in terms of the lockdown of London and the Southeast. And we're now in an environment of impaired liquidity.
Yeah.
A lot of people I know are not in the office this week or next week.
You don't say, Cameron.
Yeah. Well, funny enough, right? And if you were there, if you are in the office, or if you are still managing risk and are trying to squeeze the last few basis points of performance out of your portfolio, and then you're confronted, sort of slapped in the face, as it were, by these sort of headlines. The temptation has got to be pretty overwhelming to say, you know what, let's just dial things back. I'd rather enjoy my holidays and relax than have to sweat about, seeing the equivalent of Dustin Hoffman in one of those hazmat suits.
Yeah,
rummaging through my book.
Things that none of us want to see. Cameron, just real quick here, I'm watching the dollar because, frankly, this has been one of the strongest consensus trades that you will see a weakening dollar next year. Meanwhile, we're seeing the dollar strengthen today in a flight to haven currency type of trade, at one point the most since March. What are you watching as sort of a harbinger of what's to come, a perhaps predicting factor of how much legs this sell-off has?
Well, it's kind of tough to know exactly how much we're going to correct here. I mean, we've been pretty oversold on the dollar, which is actually, in the short run, obviously runs the risk of a correction. In the more medium term, that's actually not such a bad thing because you tend to get oversold in bear markets. You tend to get overbought in bull markets. So it's certainly not the death knell of the dollar trade, but could we correct back to where we were a couple of weeks ago? Absolutely. I mean, that's indisputable. I think it doesn't take much of an imagination to see us back at say 120 against the euro.
Cameron Kreis, Bloomberg macro strategist, thank you and congratulations for being one of those not in the office and at home ahead of the holiday. Joining us now, Bloomberg's Sonali Basak, financial correspondent, along with Richard Zogheb, Citigroup head of global debt capital markets. Sonali, why don't you bring in the concept of what we're looking at in a world that is awash in money and looking to raise more debt?
Absolutely, Lisa. We're at a point here where there's been record debt issuance in many respects this year, and it got into riskier markets. Richard, thank you for joining us because you were a big part of this, right? A top 3 underwriter for both investment grade and high yield debt. But when you look at this uncertainty in the market, how are your clients going to respond to that?
Well, I think our clients are in really good shape, having raised, as you mentioned, all of the money the record volume that you mentioned, right? We had both the high yield market and the investment grade market were up 60% year over year in terms of volume. And we had very strong conditions for the balance of the year. So all of our corporate clients have really, basically bulletproof their balance sheet to get through this difficult winter that people expect and hopefully come out the other side when we have the vaccine and herd immunity in very, very good shape. So we feel good about corporate balance sheets from a liquidity perspective, from a perspective of getting through difficult times. And then I think it's going to all come down to how robust the recovery is and can these companies really get out from underneath all of the debt they've now raised in order to shore up their liquidity.
Well, I'm glad you brought that up because that's the number one question on investors' minds right now. Are these companies just going to be grappling with this debt for the next year or so? Are they going to survive those debt loads?
That's a great question, Sonali. I think the vast majority of the companies that are only, I would say, modestly affected by the pandemic, by the shutdowns, absolutely will be fine. And a lot of them have already taken advantage of the robust equity markets to delever. They have done good liability management transactions in order to push out their maturities. I think the companies that we really need to focus on are the companies that are in deeply affected industries, the airlines, the cruise ships, the gaming companies, the movie theaters. They've taken on an enormous amount of debt. And they've been obviously the most affected by the pandemic, where in many cases with their revenues going to zero for periods of time. And so the question there is going to be, how robust will the recovery be? Can they sell assets? Can they raise equity? Because if we have a slow recovery and the equity markets are not there for these companies, we could see a number of them have to default. The hope is that the recovery is stronger than we hope, and things snap back pretty quickly. Yeah. And we continue to have strength in the equity market, and these deeply affected companies will be able to use the equity market to deleverage their balance sheets. Because if they can't, the debt load will definitely be crushing on them.
Richard, just really quickly here, I want to go exactly there, given the fact that some people are saying that this new virus strain could prolong the pandemic for an additional, say, 4 months. Is that too long? Will that lead inevitably to default for some of these companies in the most affected sectors?
I don't think the addition. I think most companies have planned to be in a difficult period until sometime in the second quarter. So I think if this extended out a month or two, I don't think that is going to be enough to sort of break the proverbial camel's back. I really think the question is if the fact that we are stuck in a difficult period of time, if that delays the recovery and it's much more modest and slow, I think that has a bigger impact on these companies' recovery than maybe a month or two delay in terms of getting the things back to normal.
Richard, if there's one big risk your clients see on the horizon next, what are they most worried about?
And I think it really is just what we've been talking about, and that is, we've got a lot of them have put on a lot of debt in the hopes that we're going to have a nice recovery in the second half of this year, get to herd immunity at some point in late 2021, and basically have a business environment that is back to normal. And I think if what people are trying to gauge is what's going to be the new normal. Do things come back? Are consumer habits changed for the foreseeable future? And is that going to really impact their businesses and therefore make their balance sheets too debt heavy?
Richard Zogheb of Citigroup, Managing Director and Head of Global Debt Capital Markets. Thank you so much for being with us. Right now in markets, we're off the earlier lows, still though lower on the day. FTSE leading the decline, 2.3% off. S&P futures 1.8% lower, and crude down 4%. This is Bloomberg Surveillance.
Chinese brands now account for 7 of the country's top 10 cosmetics lines, up from just 3 in 2017. That has pushed out foreign brands like L'Oreal's Maybelline, which has seen its share of China's makeup market plunge by half since 2010. For more, we're joined by Bloomberg editor Bruce Einhorn. Bruce, why the drop?
Chinese brands are becoming much more adept at reaching Chinese consumers, especially now at a time when more consumers are reluctant to go shopping outside. People are spending more time at home. People are spending more time on social media. Chinese brands are very good at using social media, using live streaming, using other things in order to market. Chinese brands also tend to be less expensive. And so at a time when the economy is struggling a bit, there's a lot of uncertainty, people are more budget conscious, Chinese brands have a bit more of an advantage.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
There's an argument to be made that perhaps we've gone up a little too far, too fast.
These companies have had these parabolic moves. There will be a day of reckoning.
When you look at hiring, you're seeing those permanent layoffs increase.
It's quite possible that you'll see numbers start to disappoint. The real yields haven't gone up, which is another reason why the Fed price stood pat.
It's going to be really difficult for the Fed to latch onto this notion that they're not going to do anything until 23.
The way people are spending, the timing of that spend has really shifted.
I do see the economy getting back to something close to normal in the second half of next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast on Bloomberg Radio, Bloomberg Television. We welcome all of you across the nation, around the world. The stark fact, John Farrow is off. How will we survive? It is questionable, Lisa, whether we can possibly get through the week without Jonathan Farrow. We'll have to do more data checks and
the
talk
cats.
about the real yield.
We'll be roaming around the set,
Yes,
waiting for someone to rein us in.
Do lots of cats interviews as well. It has been an extraordinary 24 hours, folks. We're going to give you more data checks through the morning. We're going to do that right now, but into the concept of a United Kingdom that is shutting down. We've been doing this all morning. Thank you particularly to Paul Hunter of East Anglia. Just, Lisa, your thoughts on the medical interviews we heard this morning.
Well, there's an uncertainty here, and this is what seems to be getting people nervous. There is a belief that the vaccine will also prevent against getting this new strain of the virus, which is more contagious, but not materially different, but not certain. There also is uncertainty about how quickly it's spread already. We don't necessarily have the genetic sequencing. Look, I'm not an expert in this. I don't want to go off speaking out of turn. What I do want to say is it definitely has added to this unease that perhaps markets have gotten a little bit past themselves, a little bit gone too far, too fast, and this morning is a sell the news and start to take stock of the now.
And what is so important about this, folks, is the jump condition feeling of 2 hours ago where VIX blew out to 30, even 31. We've come in a little bit. We're going to frame the data for you here throughout all of Bloomberg surveillance this morning on radio, on television. Just futures, well, futures negative 64. They were negative 100 earlier. That's Standard & Poor's futures. Dow futures now negative 488. We'll do more on the data here in a moment. Lisa, give us the observations you see wrapped around Washington and, of course, what we see in Britain as well.
Yeah, well, today, just sticking with Washington, D.C., we are expecting the U.S. Congress to vote on that $900 billion fiscal support plan. And that's why I say this is a bit of a sell the news kind of day. People were expecting this to be passed. This was priced into markets, and you're seeing people kind of shrug. We'll dig into just how good or tepid this is in terms of bolstering the economy as the pandemic continues to rage. 1 p.m. today, we're also getting a U.S. sale of $24 billion 20-year treasuries. Great day for the U.S. to sell debt, given the fact that there is a flight to havens, and we are seeing yields go down, price up. They will get more money for their buck. And then also today, President-elect Joe Biden is expected to get the COVID vaccine. The crucial aspect, Tom, is the public relations one, the idea of trying to convince people that it is safe to get the vaccine and that as soon as they are able to, they can go get inoculated to try to prevent the spread of this disease. That has been a concern of a lot of people, that perhaps there will be distrust, even in the medical community, and not will be willing to necessarily get the protection that will end this pandemic, Tom.
And of course, the dynamics here of cases, I'm not a big fan of case analysis, full disclosure, folks, but the death analysis in the United Kingdom and particularly in the U.S. is extremely difficult, and hospitalizations really front and center here. Paul Hunter of East Anglia said hospitalizations less of a problem in the United Kingdom. I want to take you back 2 hours ago, and particularly for those of you waking up across America, what shocked me was to see Ireland shutting down plane flights to the United Kingdom, the Netherlands, France shutting down the Dover to Dunkirk pathway, and then Lisa as well, the Eurostar, which has already been heavily truncated, shutting down. It's truly a shutdown United Kingdom, Lisa.
Yeah, and we're seeing these headlines about the possibility of food insecurity or perhaps, supply chains getting disrupted with respect to medicines. I don't want to sensationalize that, Tom. To be clear, we are not hearing of food shortages at this point. We are not hearing about disruptions that are massive at this point, but it's still early, and it raises this concern that we're not out of the woods just yet.
Off the radar for the United States, Brexit, and yes, a little bit of Brexit with, among others, the mayor of London saying today, extend out Brexit, move the talks or the dates or whatever out because of the seriousness of this pandemic. It was a book of the year a few years ago, and it is a book that has aged well across the financial crisis, The Age of Oversupply. Daniel Alpert joins us from Westwood Capital this morning. Daniel, it's been an extraordinary year, a year everybody wants to forget. As we slide into 2021, where is the output gap? Where is the dynamics of our oversupply?
Well, I think what we've seen recently, which is fascinating, is the huge resurgence in imports from China and other countries. So what we haven't seen is the reshoring of manufacturing, the reshoring of production in general. And when I look at the import-export data, it's just fascinating to me how much we are reliant on exogenous oversupply, and of course at the worst possible time when a good deal of our labor force is underemployed and unemployed.
Well, I wanted to start where I wanted to go, Daniel Airport. Many of us folks have projects for 2020 that we have not accomplished. Dan Alpert is the opposite with Cornell Law. He has put together a terrific analysis of the labor dynamics of the nation. Dan Alpert, how bad is it?
Well, we have somewhere around 12 million people who are not employed, whereas prior to the pandemic they were. I think that masks considerable softness in the labor force that's exhibited every week when we look at unemployment claims. These unemployment claims are no longer original layoffs, meaning if you aggregate the entire amount of unemployment claims to date, you're nearly at 35–40% of the labor force, and clearly we don't have 30 or 40% of the labor force unemployed. So what you're seeing is incredible instability in the ability of workers to hold on to jobs. And, a classic example of that, obviously, is what happened in the restaurant industry over the summer. Warm weather and what have you allowed people to reemerge, open their restaurants, and now you're seeing the same thing play out in reverse. So not just the restaurant sector, but throughout the economy, you're seeing repeat layoffs, repeat unemployment. The same people, many of the same people who filed in the spring are being forced to refile again.
Daniel, how far does this $900 billion stimulus effort in Washington, D.C. go to bridge the gap for all of these individuals that you're talking about?
Well, as a calendar matter, obviously it goes through the first quarter, and it's clearly, enormously necessary. The $300 weekly benefit for weekly supplement for unemployment is urgently needed. These people are going to go. Many of these people are going to lose all of their benefits. So the extension of the benefits and the addition of the $300 supplement was clearly needed. My big concern right now is the reestablishment of the PPP program. It's interesting because the PPP program really was an alternative way of getting payroll back to people who may not have actually been called back to work, but were given the opportunity to receive funds. The problem this time around isn't so much that the unemployment system isn't working. This $300 supplement's really going to help, and we're going to get. We clearly have a fairly high level of household savings that's gradually burning off. The problem right now is how the businesses are going to survive. So I'm very interested to see the language in the bill, specifically with regard to the use of the new PPP proceeds, meaning I think it's about $230 billion, whether or not businesses are going to be able to use these proceeds, not just to supplement or put people back on payroll who they currently can't employ, but also whether or not they're going to be able to use it for other expenses such as rent and other payables that they've accrued over the last several months.
Well, you talked about, in addition to the companies and their concerns, the high savings rate among individuals. Do you think that the direct payments to individuals will be effective given the fact that they will target the people who are most vulnerable, or do you think that that money would have been more efficient elsewhere?
Well, what I do think is going to happen is we're going to see an increase in the savings rate in the first quarter. So you have the $600 per person checks for the middle class and working class. Those will go out. Those may get expended, or they may not, as the lockdown period demonstrated. In that period, we had a huge increase in retention of funds. Right now, given the viral surge, you have to ask yourself whether or not this period is going to see, the first quarter is going to see an increase in consumption as opposed to savings, because if people are sitting at home and worried about the virus and not getting vaccinated until the second or third quarter, you're probably going to see at least some of the same phenomena you saw in March through June.
Dan, congratulations on your work with Cornell Law this year, truly adding value to the view of our labor economy. Daniel Alpert with Westwood Capital. I can't say enough about really what has become a timeless book over a decade, the age of oversupply. Lisa, I look at the markets and I guess I'm looking at a recovery as we reset off the shutdown of the United Kingdom. To me, Lisa, this is correct. It is a shutdown of a nation.
Yeah, it's a shutdown, and it comes into the face of some very real new news, this idea of this new strain of the virus. I will say that the move that you're talking about in markets, the retracing of some of the decline in equity futures, highlights the buy the dip mentality. I mean, basically, people have been waiting for a sell-off, and it just highlights how much money is out there. What? You're sighing. What? You're skeptical?
I'm looking for an entry point.
Oh. With your triple levered cash. Yeah, I hear that there's
I'm not quite there yet.
I have a couple of barrels of oil to sell you.
I'm just not there yet. I look at some of the foreign exchange market. Dominic Bunning with us with HSBC earlier, and really the backup in some of this foreign exchange on a tear, weak dollar, strong everything else, and that is abruptly reversed this morning. Coming up, one of our themes with Vasilios Giannakis of Bank Lombard ODA. We'll do that here with futures at negative 58, Dow futures negative 413, the VIX 28.35. Please stay with us on radio, on television. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Congressional leaders have reached an agreement on a $900 billion spending package to boost the economy. Most Americans would get a one-time $600 payment, and there would be a $300 a week in enhanced unemployment benefits through March. And the Paycheck Protection Program would get $284 billion, and that includes forgivable loans for small businesses. Lawmakers won't have much time to review the measure. The House is set to vote on it today, followed by the Senate. A CDC advisory panel says the elderly and frontline essential workers should be next in line for coronavirus vaccines. Those frontline workers include firefighters, teachers, and grocery store workers. The first round of vaccinations is going mostly to healthcare workers and residents of long-term care facilities. Europe is moving to isolate the UK because of the latest surge in the coronavirus infections. France and Germany have joined Italy in suspending flights from the UK after London went into an emergency lockdown. The government warned of a new strain of the virus is out of control. Prime Minister Boris Johnson cancelled plans to allow families to see each other over Christmas. And Brexit negotiators are still hung up over fishing. Talks between the UK and the European Union on a trade deal missed another deadline. There are a few signs that either side is ready to compromise. The two key disagreements are access to British fishing waters and limits on state subsidies for business. Shares of Tesla are lower pre-market on the first day. The electric car maker appears in the S&P 500 index. The stock has already gained more than 700% this year. Tesla is the biggest company ever to be added to the benchmark. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
valuations, particularly sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
More help is on the way. Moments ago, in consultation with our committees, the 4 leaders of the Senate and the House finalized an agreement.
While this bill is far from perfect, nor is it the bill that we would pass if Democrats had a majority in the Senate, it is a strong shot in the arm to help American families weather the storm.
2 gentlemen exhausted over a weekend on the bill, the stress, stress, if you will, of trying to find stimulus. A gentleman from Kentucky, the gentleman from New York as well. Let me do a market check right now. Really grim 2 hours ago. Negative 100 on futures has really recovered rather nicely. Negative 60 Dow futures, negative 425. And the VIX says it all out. 7 big figures, 28.58 with an over 30 print earlier. Dollar strength confounds a weak dollar. Certitude, yen 103.66. Euro 121.70. I'm going to leave it there just to get a good briefing here on Washington. Kevin Cirilli joins our chief Washington correspondent. Kevin, in the last hour, we talked about the president, his eventful weekend, particularly in the Oval Office. Let's move on to the legislative branch and the view forward. Did the president-elect get the outcome he wanted with this stimulus bill?
Not entirely, but it's definitely still a holding pattern. And to be candid with you, I don't think Senate Majority Leader Mitch McConnell got entirely everything that he wanted with liability protections, nor did the Democrats, as we just heard from Minority Leader Schumer. But if there was not going to be stimulus, then that would have put incredible pressure on the Biden administration once they were to take office in less than a month for them to even have a more sweeping of a package. If you look at what's included in this $900 billion stimulus, $15 billion to reinstate payroll reimbursements to airline, $10 billion for state highways, $2 billion for airport and airport commissaries, $1 billion for Amtrak, and then, of course, $284 billion for the Paycheck Protection Program, and $600 checks are going out.
What's the acclaimed Cirilli pork meter look like? I mean, how much overlay is in this bill?
You know, yesterday I spoke with the source who works in a nonpartisan role with the airport regulators. And what this source told me was that the airlines were in desperate need of some stimulus. And it's just one illustration of what cross-industry people have been experiencing. And so this is, as Minority Leader Schumer put it, a shot in the arm. The question becomes twofold. One, what happens in Georgia? And two, does Leader McConnell maintain his slim majority in the Senate? And is he able to get liability protections in the next round of negotiations in President Biden's first 100 days? The Republicans that I talk to tell me that that's a point of leverage McConnell feels he has heading into this round of next talks.
So, Kevin, from the people that you speak with on Capitol Hill, how much of a shot in the arm does this give Republicans in that Georgia election?
A massive shot in the arm, because no longer can Raphael Warnock or John Ossoff attack Senators Loeffler nor Perdue in saying that they did not get stimulus passed. And so that's the biggest contrast, so to speak, in terms of what happened in the November elections, was that this was really shaping up to be a closing argument for Democrats. Ivanka Trump will campaign there later today in Georgia. Meanwhile, President-elect Biden has campaigned there. It's an incredibly high-profile race, one, quite honestly, that we haven't seen in quite some time in terms of a lame duck runoff election.
So, Kevin, given the fact that there seems to be popular support for these stimulus bills to try to keep people afloat, will Republicans be more amenable to an additional stimulus package next year if they have the majority, if they continue to maintain the majority in Senate?
I'll be blunt. no, if the prism for these negotiations remains as it is today, and the perspective of those negotiations remains on simply getting, not simply, but getting people back to work. If the scope of the conversation is expanded, if it is expanded to include cybersecurity protection, as we've seen, for example, the issue that has come up in the past week, and to secure digital infrastructure from a national security perspective, then yes, I think that Democrats will find, based upon my reporting, more of an open ears from some Republicans. But the prism of right now, no, I think that there are many Republicans who are just waiting to speak out against more government spending.
I look, Kevin, at where we are, and frankly, it's a blur. Now, you've got to get to the end of the Eagles season with the Washington Redskins in first place. It's, you know, they're not even playing 5 in a ball.
The Washington football team. The Washington football team.
Oh, my folks' pa.
The important topics.
Kevin, what's important here is we're trying to get to Tuesday of this week. How are you going to get through? I'm serious. How are you going to get through Monday down there? What are you going to do today in terms of the calls you're going to make?
I think I'm interested to see and to continue to look at the financial team, cross agencies that the incoming administration is putting together. And I think that is going to be really, to Lisa's point, to your point, the guiding foundation. And when you're talking about this much stimulus, which is an incredible amount of money, right. I mean, you'd have to go back to Roosevelt and Hopkins in order to see this type of robust economics, grassroots, American worker mentality that we're shaping up to experience.
Very good. Kevin, thank you so much. Kevin Cirilli with us in Washington with some great historical perspective here of the record stimulus of months ago and now a new second largest stimulus ever in Washington. Futures negative 66. The VIX 28.90 as well. Coming up on the markets, Vasilios Giannakis will join us on Bank Lombard Odier. And of course, we will look at Europe in the closing down of the United Kingdom. Sterling right now, 132.80. This is Bloomberg. Good morning.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Good morning, everyone. Bloomberg Surveillance, Lisa Bramos and Tom Keene. John Taro off today and all this week, which is, we miss him terribly because markets are really on the move. Lisa, let's review this for people on radio and TV really diving into it. Vasilios Giannakis to join us here with Bank Lombardi ODA in a moment. To see the VIX go 2 big figures is a big deal, Lisa. Out 5 big figures, out 7. At one point, we're out almost 9 big figures. That's a huge jump condition in volatility.
And it's a change in the narrative. And this is important because we had the biggest consensus that many people had ever seen heading into 2021, that things were going to be so much better. This rotation into cyclicals, this idea of potentially weaker and weaker dollar. That's all being challenged today, Tom, in a serious way. And that's raising questions about the stability of this trade. I mean, again, it's actually eased off the lows, but still, this is the first real sell-off that we've seen in months.
U.S. two-year yield was a 0.10 handle for a bit. We're back to some form of normality, 0.1149 in the U.S. Two-year yield, 2-10 spread comes in 4 basis points as well. Oil showing some angst. Brent crude down $2, $50.18, down 4% on Brent crude this morning. With FX as a prism, joining us now, Vasilios Giannakis with Bank Lombard ODA and their global head of foreign exchange strategy. Vasilios, the shutdown of the United Kingdom by air, by sea, by the Eurostar shutdown across the channel, how will that filter into the financial markets of Europe and the United Kingdom?
Well, Tom, I think it's been manifesting as we speak, and that's largely been seen in sterling. And I think in a more generalized risk-off mood in the market. I think this one in particular, we need to treat it more as a temporary event, as a temporary shock. My understanding is that the EU is having an emergency meeting to see how they can alleviate restrictions, because realistically they cannot be put in place for a long period of time, especially as supply shortages is going to be a big threat to the UK. But at the same time, the market is also keeping an eye on the Brexit negotiations. And in terms of Brexit negotiations, we're still at a deadlock. And that is the thing that we need to take a bit more into account.
Okay, so the Brexit's going to be there, and there's people looking for Brexit delay as well. Can you be tactical this morning? 2 hours ago, I should say, was ugly, and we've really rebounded nicely this morning. Can you be tactical and place trades and speculative bets this morning?
Well, I think this morning, right now, on a very, very high frequency trading, I wouldn't really want to do anything on FX at the moment. And I say this because we're struggling with something which is can be very temporary and very short term, and something that could potentially have more structural implications. But I think, let me say the following. I think we need to ensure that we keep in mind that the big picture is not really changing, because the vaccine rollout, the vaccine distribution, and therefore the pandemic outlook is certainly much, much better going into 2021. So from that respect, and if you put these together with the fact that there is going to be a recovery in global trade, importantly, and global growth, I think that this rally in the dollar will provide good entry opportunities for re-entering shorts again.
So, Vasilios, that may be the case, but the move that we saw today, which at one point was the biggest strengthening in the dollar that we've seen going back to March, raises an issue of positioning. This groupthink that we keep talking about, the fact that people are all piled into the same trades, whether it's long S&P, whether it's short the dollar. How much does that increase the potential for volatility going forward?
Well, I think it increases the volatility it increases the potential for a short, big spike in volatility, because, as you said, we're talking about a lot of consensus trades. Equities registering new highs, the dollar shorts were really piling in, and euro dollar was at an extreme long. So therefore, the likelihood of a strong dollar short squeeze is very high and quite likely, in my view. But I think there will be a point, and I don't think that we're very far away of this. Unfortunately, I don't know exactly when, that we're going to see some cleaning up of this positioning, and then again, the general macro backdrop and the brighter outlook are going to start kicking in and sinking into investors' minds. And I think we're going to see another leg lower in the dollar, basically.
Do you try to dig in and understand that tipping point when some of the shorts are kind of pushed out of the market, or do you just sort of feel it out?
No, I think you have to. I mean, you have to look at the number of various indicators. You have data coming out from the CFTC. You look at various risk reversals indicators. You also look at the extent and the depth and the breadth of the move of individual currencies that have potentially gone into overbought territory against the dollar. And you combine all of these indicators and signals, and then you come up with some sort of trades that you would like to apply once you believe that this rally in the dollar and that sharp spike in risk aversion is behind us.
Vilios, love it when our listeners and viewers email in. John from Capri emails in and says, what's the likelihood of negative interest rates across the United Kingdom and, frankly, across the United States? Everyone is telling us this isn't going to happen. All my radar's up because of that.
Well, look, I think that's a very good question. I think I
didn't ask it. This guy John asked it.
I think it's only death and taxes, right? I mean, anything is possible. But if you ask me to assign probabilities for these two events, I would certainly assign a much, much, much lower probability for the US compared to that in the UK. The UK has, the Bank of England has told us that they have been studying the matter quite extensively. There have been voices by the Bank of England who have actually been supportive of negative rates. The same thing has not happened with FOMC members. So if I was to bet for one versus the other, I would say that the BOV bringing rates into negative territory is more likely compared to the Fed bringing rates into negative territory.
Is there a permanence to the EM strength that we've seen, really regardless of the United States dollar? Is there just a new permanence to Pacific Rim EM strength?
I think there is a big element of truth on that, and I think that's largely because of China. And the thing about China is that not only we are at pre-pandemic levels in terms of activity, but also we have a very, very strong precedent that tells us the following. Pandemic emanated in China, and China, because it is very, very centrally governed, managed actually to overtake such a big crisis very quickly. So I think that increases the confidence of investors even for future shocks. Now, to the extent that you have these, plus the fact that you're seeing the authorities being quite relaxed about the general strength, the trend strength that we've seen in the renminbi, and you put that right next to the fact that the capital account, there are being steps to internationalize the capital account even more, I think that gives you quite a solid medium-term outlook for China, and therefore, by implication, it gives you quite a solid outlook for all the satellites around China.
We're speaking with Vasilios Giannakis, Global Head of FX Strategy at Banque Lombard Odier. Vasilios, a lot of people pointing to the trillions and trillions of dollars of cash that central banks globally have been pumping into the financial systems, directing risk assets. But it raises a question, how much of an effect do monetary policies really have on currencies anymore when there's just so much cash? We've already had the race to the bottom. At this point, how much do you use potential central bank policy as a guidepost for what foreign exchange may do?
Well, that's an excellent question, and because that brings me back to the point that I made earlier in the year, in that when the Fed dropped rates to zero, it actually brought pretty much everything in a level playing field, which, as I understand, is quite an extensively used term nowadays. To that extent, when you compare countries which operate, say, within 50 basis points of that level playing field close to zero, monetary policy really is not going to be that much effective in terms of having implications for currency movements. Because at the end of the day, even quantitative easing can actually work in ways that we didn't expect. I mean, with the ECB, we had a massive stimulus package. We had further stimulus by the ECB, yet the euro has actually increased. Where monetary policy can actually play some role is where there is still some carry left, say in the vicinity of 200 basis points, and that will tend to increase because some EM, for example, central banks start for whatever reason to become a bit more hawkish. But under that, main central banks, it's difficult for me to imagine that they're going to play an important role in currencies.
Vasilios, thank you. Terrific briefing on a tumultuous Monday morning. Vasilios Giannakis with Banque Lombard Odier. I look, Lisa, yen 103.65 maybe surprises me more than anything. Yen really hasn't backed up against strong dollar. Euro does a bit, 121.79, Lisa.
Yeah, I'm just struck by the fact that the market just really doesn't want to stay down. People are coming in, they're buying this, right? And then to me, this sort of highlights this key question, which is how much can we see a sell-off given how much money central banks have printed? I mean, this is the quintessential question. The markets are not a barometer of economic health. The economy is struggling despite the stopgap measure that Washington, D.C. is about to pass. So, you know, how much can we see a sell-off?
I mean, what's so interesting here and really, really important is the idea of the medicine involved in this pandemic, in this variant or mutation of the virus. That's the cause of the latest crisis in the United Kingdom. But will that transfer over to Europe? I saw a number of readings from experts. Yes, that's likely, but I really haven't heard it coming over from to the United States yet. We'll have to see how that plays out in the coming days. We'll bring you those experts, particularly from the Johns Hopkins University. Again, futures negative 62, Dow futures negative 440 as well. The VIX 28.72, up a good 7 big figures. We were out over 30 earlier. 2-year yield 0.1149. In Germany, that 2-year negative 0.744. Lisa Abramowitz and Tom Keene, please stay with us on radio, on television. This is Bloomberg Next. Test.
With the First Word News, I'm Rishka Gupta. Lawmakers won't have much time to review a $900 billion economic stimulus plan that congressional leaders have agreed on. Both the House and the Senate are scheduled to vote on it today. Most Americans would get a one-time $600 payment. There would be $300 a week in enhanced unemployment benefits through March, and the Paycheck Protection Program would get $284 billion. That includes forgivable loans for small businesses. U.S. officials acknowledge there will be a lengthy effort to determine the extent of a suspected Russian hack on federal agencies and private companies. Republican Senator Mitt Romney says Russia acted with impunity, and he says President Trump has a blind spot about it. The president has contradicted U.S. intelligence officials and suggested that China may be behind the cyber attack. And President Trump's campaign is turning to the Supreme Court again to challenge the election result in Pennsylvania. It's filed another long-shot appeal aimed at overturning 3 separate decisions from Pennsylvania's highest court. The Supreme Court has already rejected 2 efforts to overturn Joe Biden's victory in pivotal states. And Elon Musk has inquired about converting large transactions of Tesla's balance sheet into Bitcoin. Musk has had an exchange of tweets with a prominent booster of the digital currency, Michael Saylor. Saylor urged Musk to shift US dollars from the electric car maker to Bitcoin. He said Musk would be doing shareholders a $100 billion favor. And Wall Street is set for big buybacks at the first of the year. The biggest U.S. banks will be able to buy back as much as $11 billion of their own shares. The Federal Reserve gave lenders the green light to resume purchases. That followed a second round of stress tests for the banks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
You changed as a leader since that day in 1993 when you joined Roche?
You develop over time, and it's a series of experiences which hopefully make you a better leader.
The trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We believe Tesla
will be in the pole position to dominate, mostly because of its advantages in artificial intelligence and the amount of data it has collected and the AI expertise that it has. The winner in autonomous is going to have the most data and the highest quality data. That company right now is Tesla.
Kathy Wood of ARK Investments, and boy, is she getting some acclaim and notoriety over terrific performance and trying to figure out innovation, trying to bet on a market to the moon, a melt-up certainly in her neck of the woods. Colin Rush has done as well. He's at Oppenheimer and Company, and with the securities analysis heritage of OPCO, we are thrilled that Colin Rush could join us, ranked #1 in A&R, for being on board with Tesla as well. Colin, Tesla just goes and goes, confounding those that are negative. What's the next hurdle for Mr. Musk and Tesla?
Really, there's a few hurdles, frankly, given where we're at from a stock perspective. First, they have a couple of factories that they need to ramp, one in Berlin and one in Texas. And then, the quote that you were talking about, or you shared from Kathy, is I think really gets to the heart of the matter. The company's going to have 1 million vehicles on the road, all collecting data for their AI system around self-driving. And really, taking that data and turning it into real products that consumers can use. And importantly, we think ultimately that the company can use for a fleet of robo-taxis.
The index dynamics of Tesla joining the S&P 500, there's some great parsing of this ETF and that and what Tesla does. Is it unusual to you, or is it just business as usual as a high-flying stock joins an index?
Honestly, I haven't gone through anything like what we're going through with Tesla in my career, and clearly a lot of folks have not. So, with this, I think what investors are trying to come to is what's the right exposure on the transformation of the energy industry, whether it's from the transportation perspective, from a power perspective, or from a materials perspective, and Tesla has exposure on each of those elements. And so this is a name where you get exposure on a lot of disruption in a lot of major markets, and a company that's really leading the way on all three elements of the economy.
Colin, this has been an incredibly difficult company to map out in terms of its trajectory. People call it a faith-based stock. You're talking about batteries. You're talking about artificial intelligence and data. You're talking about electric vehicles. And then you're talking about carbon credits, which has actually been their financing over the past few years. Peter Atwater of William & Mary, a professor there, said that this stock could be a Trojan horse for the S&P because of its volatility and because of the lack of clarity into its future. Do you agree?
No, I don't at all. And I think it's important to just disagree with you on one point around the carbon credits being a source of, or the source of financing. I think it's been an element, and at the end of the day, a couple $1 billion out of all the capital that they've raised. But at the end of the day, this is investors' money that's been used very judiciously to create a lot of very important technology that's transforming major elements of the economy. And so certainly it's a challenge for the S&P to swallow something of this size and of this volatility. But I think it's reflective of what's going on in the broader economy. And certainly as we go forward, we're going to be watching this company closely. And I think actually with the broader base of investors in the stock, I think there is some hope and a likelihood that the stock actually becomes less volatile here.
Well, but what about the argument that Ford and General Motors could potentially actually rival Tesla given their manufacturing footprints and their experience making cars? Do you just dismiss that outright?
No, not at all. And I think it's an important thing to parse out, and it's been core to our call on the stock. Is first, there's an awful lot of IP and material IP that goes into battery production. And we saw that earlier this year with the move to a different form factor, the evolution of materials and manufacturing processes going into the batteries. But beyond that, taking that chemical energy that's in the battery and turning it into a propulsion system is quite complicated. And that's a lot of software. It's a lot of know-how in terms of how those motors work and how the motors work in application. And then beyond that, what Tesla is doing in terms of evolving the manufacturing base, in terms of simplifying the structure of the vehicle, is incredibly important for lightweighting, but also for cost reduction at the end of the day. So certainly there are very, very capable companies out there, but there's a couple of things that are important here. One, they're trying to service, legacy technologies while trying to evolve into new technologies. And I think all of the auto industry is challenged with a durable goods market where you've got, consumer electronics type technology cycles moving. And Tesla's really had a narrow focus that is moving forward and cycling on this technology far better than the other companies out there.
Colin, buried in the library at Wesleyan long ago and far away was a copy of Graham, Dodd and Cottle that you didn't read. Your world isn't in Graham, Dodd and Cottle. Just look at Plug, Latham, New York, 800 some employees, $2 to $31. Why is that, Colin?
It's really about investors looking for the companies that are disrupting these big markets that we talked about. And Plug's done a fantastic job over the course of 2 decades of building out not only a technology platform, but more importantly, looking at the right form factor for taking hydrogen into a mode of application. And beyond that, building out an infrastructure of fueling stations. They're in warehouses, which I think are a critical element of what we're going to see in terms of applications for hydrogen and adoption in the middle mile, last mile delivery. But then importantly, in terms of buying some electrolyzer technology that's going to turn into some major plants for producing green hydrogen over the next few years. And that company is something that, really has all of the key elements for, being a hydrogen leader. And we see them executing well over the next number of years.
Colin Rusch, thank you so much, of Oppenheimer & Co., senior analyst, talking about Tesla and their inclusion in the S&P today, the first day. Tom, I got called out for saying it was pocket change, that it was down 3.7% ahead of the open after the 750% gain year to date. But it sort of highlights the volatility of this massive stock that's entering one of the main benchmarks around the world.
I didn't do a standard deviation study on Tesla this weekend, but I do take your point, Lisa, that it's going to have a more inherent volatility than a lot of other stuff that we follow out there. Lisa, we've got some stability to the tape. To me, that's what's really important here. S&P futures negative 100, now negative 63, 1.7%. Boy, that's a lot better than 2 hours ago.
Yeah, there's the sense here that perhaps the news has changed slightly, but not enough materially to change the backdrop of central bank liquidity, of fiscal policymakers trying to step up and putting some money into the system, and this feeling that still at some point the pandemic will end.
In foreign exchange, the euro 121.69, down from that 122 level. Stronger dollar, DXY 90.3-ish out to 90.6. I don't want to oversell this, but nevertheless, a real pushback against weak dollar on this difficult day for the United Kingdom. Again, if you're just joining us, stimulus, we've got that in Washington. And in the United Kingdom, horrific virus news, the shutting of their borders. Coming up on the credit markets, George Borey, Wells Fargo. On radio, on TV, this is Bloomberg.
Your debt. Things they didn't teach you in school, part 4. When we think of debt, we often automatically think of a horror film. But debt doesn't have to be the scariest thing in the world. If you found yourself with some debt that's stressing you out, here's how you can manage it. First, prioritize your payments and pay down the debts that are costing you the most. How do you find that out? Look at your interest rates on your monthly billing statement. If your credit card has a really high interest rate, you'll want to pay that off before paying off something like a student loan, which might have a low interest rate. The average interest rate on a credit card is 14.5%. So you're getting a good return on your money when you pay that debt off. Next, track your spending. Stick to a budget so you can know where you stand financially and start to save some money to pay your debts down. You can do this with apps like Digit, Acorns, and Stash. And lastly, breathe. Know that every financial mistake is fixable. You can always recover down the road, but it's best to get ahead of any mistakes that could lower your credit score. And a good credit score can save you a lot of money, earning you a lower interest rate in the future.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
COVID-19 pandemic has hit the U.S. economy hard.
But the damage has not been evenly distributed.
Now comes the challenge to rebuild more equitably. Join us for a Bloomberg special report, The Unequal Recovery, on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
There's an argument to be made that perhaps we've gone up a little too far, too fast.
These companies have had these parabolic moves. There will be a day of reckoning.
When you look at hiring, you're seeing those permanent layoffs increase.
It's quite possible that you'll see numbers start to disappoint. The real yields haven't gone up, which is another reason why the Fed price stood pat.
It's going to be really difficult for the Fed to latch onto this notion that they're not going to do anything until 23.
The way people are spending, the timing of that spend has really shifted.
I do see the economy getting back to something close to normal in the second half of next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone, on TV, on radio worldwide. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz. We are together with you, except that John Farrow has stepped away, stopped herding cats for a while, and left Tom and myself here to hold down the fort. Tom,
life is so much easier,
for him or for us?
Probably for both. That's well said. What do you got, Lisa?
Well, honestly, yesterday the news was encouraging out of Congress with the stimulus package getting passed. This expectation that we would get some fiscal support. Today, the news is grimmer. A grimmer Christmas time, a grimmer pandemic, a grimmer Brexit, and you can feel it on the tape throughout the morning, Tom.
You can see it on the tape, but folks, the headline service of the Bloomberg today has been agonizing, particularly for the people of the United Kingdom. This just across BBC, COVID in Scotland, quote, don't meet indoors on Christmas Day. I mean, that's really, Lisa, what this has come down to. The ramifications, Lisa, through the market, including futures, 2 hours ago, a negative 100.
Yeah, and this really raises a question. A lot of people talking about inflation, this idea that the Fed printing all this money, that you've got fiscal support coming out. And the big question for next year was, will this juice inflation? Today, the answer seems to be not necessarily, especially if we've got a pandemic that could potentially drag on longer as people have to stay masked and stay distant, even for the holidays.
One of those measures, the real yield was horrific 2 hours ago. Right now, negative 1.05. That's a lower, greater negative yield by 2 basis points, but certainly much worse a number of hours ago. I believe we got to negative 1.10. Lisa, what on the data screen gets your attention?
Well, honestly, I've been looking at the dollar because this has been one of the big consensus calls. Everybody hates on the dollar and thinks that it's going to fall off a cliff. And today, it's the opposite. You actually saw it strengthening the most since March, and you could see the euro weakening versus the dollar going right back down. It's got to be comforting, frankly, to the ECB, given the fact that this is a drag. The strength of the euro has been a drag for them. S&P futures down also, but really off the lows that we saw today in pre-market trading. I mean, it was down, what, 2.5% earlier this morning?
Yeah, it was really, really ugly as well. We welcome all of you on Bloomberg Radio across this nation, particularly Bloomberg 1130 in New York, waking up to, among other things, the New York Jets winning. And, of course, this is extraordinary, much like the conjunction of Saturn and Jupiter that we're seeing, the first time since 1226 that we're seeing those two planets line up in a perfect line with Earth, a very rare occurrence, just like that Jets
important stuff in the morning.
win. No, the Jets, I mean, come
Happy
on.
Monday.
Astronomy and the New York Jets football, I mean, it
hand in hand.
It somehow fits as well. Futures negative 63, and again, 7 big figures on the VIX, and we'll do more data for you on radio and television across surveillance this morning. On the fixed income market, George Borey, he is with Wells Fargo and is hugely attuned to the clipping of coupons and the search for total return. George Borey, in 2021, am I content to clip a coupon, what little it is, or dare I can say I'm looking to try to find total return?
Yeah, good morning, Tom, and thank you very much. Calling from Wells Fargo Asset Management to kind of talk you through fixed income. And as you point out, yields are still very low. But as Lisa just mentioned, you can't give up on bonds just yet, whether it's the dollar or U.S. Treasuries. You know, when people get uncertain, bonds rally, and they tend to really be the anchor for your portfolio. As we think about next year, what you're seeing right now is a little bit of a reversal of the trend that's been pretty well established. And our view is that as we get into next year, that view is going to continue. Yields are likely to continue to creep a bit higher. And I say a bit because there are a lot of very strong forces. You mentioned several already. Limited inflation, growth that's uncertain, the trajectory of COVID. It's very difficult to just simply, throw in the towel and give up on your bond trade. Bond yields are low for a very good reason. They're likely to stay pretty low, but we'll see a little bit of incremental move up. So for us, your biggest job, your most important job as a bond investor is, number one, it is capital preservation, making sure you maintain the gains you've captured over the last 3, 5, 10, 12, 30 years. Bonds have had a great run. But look for extra income. Look for that coupon. Look for that just a little bit of payment that's coming your direction. It's not easy, but, we do find corners of the market, pockets to try and add that income to the portfolio.
George, I'm struck by what one noted bond manager said last week, Scott Minard, who came out and said, you don't want to hire an optimistic bond manager because you just want to get paid back. And I'm looking right now, and bond managers seem to be really optimistic when you look at what people are demanding to own the lowest rated debt, given the fact that companies are still struggling. The economy is not back to normal. Do you feel like people have gotten a little bit exuberant when they've gone into this lowest rated debt, given that it's paying almost record low yields at this point?
There's a big assumption baked into the markets, and that's both fixed income and equities. And the first big assumption is that the Fed's got your back. The Fed's going to be with you every step of the way, and they're not going to allow yields to rise significantly. The second is that that inflation is going to remain very well contained. Those are the two factors that I think we think underpin kind of that bond market enthusiasm, if you will. There's good reason for both of those. As we said, as you mentioned, the data looks to support the inflation story, and the Fed was pretty committal last week in terms of its willingness to support the market. So I don't know if it's an optimistic bond investor, but they're certainly content. And there is a certain amount of complacency in the market that does concern us. And in spots of the market, we think the market's run a little too far, a little too fast. Investment grade corporate debt is one of those parts of the market. If you look this year, an interesting stat, spreads are basically, credit spreads for corporates are just about back to where they were at the beginning of the year. Year over year, one of the smallest changes in credit spreads almost in history, but one of the largest ranges from top to bottom over the course of the year. So if you look at this in the history books, you're going to say not much happened for investment grade credit spreads in 2020, but anyone that lives through it knows it's been one heck of a wild ride. Spreads there look tight. We want to take some profits, not sell it all, but take some profits and move that money into other things, maybe a more kind of conservative position in mortgage-backed securities, higher rated, or even go down in quality. And we will take some optimistic strategies in high yield, which again, pretty optimistic, but we've got to find those coupons.
George, just keep plowing through. That's what we all do. I will say, that's well done.
Morning.
So if we gotten to the point where safe bonds aren't so safe anymore?
Well, that's a great point, Lisa. And based on that sort of belief about the Fed and interest rates, your biggest challenge today is not so much your sort of your corporate behavior, but just very long durations. The long maturity you have in a bond with very low yields means any marginal increase in yields, it could represent a pretty big loss in your portfolio. So we're watching that. As I mentioned, capital preservation. You have to be very careful about where you position along the curve. We do have a preference for short to intermediate dated bonds that provide you with a little bit of protection. Long dated purchases need to be for long dated investments. These are investments in pensions, in very long-term savings accounts, and for longer duration insurance companies. We want to be careful at the long end of the curve. We want to try and maximize as much yield as possible at the front end.
Right.
And we think that's a sensible strategy right now.
George, you've been doing this way back to Fleet, 1992. And one of the things that upsets me no end is the belief that bond money will move into equities. What is your experience of psychological bond money all of a sudden finding the equity market? Does that actually happen?
It happened. Not as much as maybe we think. I mean, there does, obviously there's very large asset allocation teams that are constantly managing between bonds and stocks. And as one runs ahead of the other, they'll allocate back and forth. We have a whole team that does that. Many of our competitors do. And that is sort of the balance of the market. The big run-up in equities, has driven a fair bit of money into bonds. We expect that trend to continue.
Interesting.
We have not seen the trend go the other way, at least not yet. There are some discussions about why you hold bonds and how long you should hold them for. But as it stands today, there's still a bias to move out of equities and into bonds and trying to immunize portfolios as you move through time. So in my long tenure, it's been mostly the other way. And although there's a lot of discussion about it this year, we've yet to really see a meaningful shift going from bonds into equities. And we really don't think that's going to happen just yet.
Great Monday briefing, particularly in this market tumult. George Borey, thank you so much, as Wells Fargo Asset Management. In the bond space, in the Borey space, 0.1129 in the 2-year, 10-year yield under 0.90% as well. 30-year bond, I haven't even quoted today, 1.64% in 5 basis points in the 30-year bond. Lisa, that's a nice move. And curve flattening. Is it a bear flattener or a bull steepener? I have no idea what that means.
Yeah, well, it's...
I've never gotten...
I'm just struck by Jets winning. They were 0-13 heading into this game. It's a Jets flattener. It was sort of plowed over and then, ticked up a little bit. This is their tick up.
You're just
1 out of 14.
With that. You're way on. You're just on the edge of knowledgeable on that as well.
On the edge of knowledgeable. Can we have T-shirts made?
Futures. Let's do the futures right now. Negative 66 again on S&P. Futures dollar index. Lisa's been beating on this all morning. Weak dollar forever trade. It takes a pause this morning. 90.60. Thanks to Vasilios Giannakis for making us smarter on foreign exchange. Dominic Bunning of HSBC as well a few hours ago. The euro 121.75. On this virus, on our variants and mutations, Mercedes Carnathan of Northwestern University will join. Please stay with us on radio and television. An extraordinary Monday. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Congressional leaders have reached an agreement on a $900 billion spending package to boost the economy. Most Americans would get a one-time $600 payment. There would be $300 a week in enhanced unemployment benefits through March. And the Paycheck Protection Program would get $284 billion. That includes forgivable loans for small businesses. Lawmakers won't have much time to review the measure. The House is set to vote on it today, followed by the Senate. A CDC advisory panel says that the elderly and frontline essential workers should be next in line for coronavirus vaccines. Those frontline workers include firefighters, teachers, and grocery store workers. The first round of vaccinations is going mostly to healthcare workers and residents of long-term care facilities. Europe is moving to isolate the UK because of the latest surge in coronavirus infections. France and Germany have joined Italy in suspending flights from the UK after London went into an emergency lockdown. The government warned that a new strain of the virus is out of control. Prime Minister Boris Johnson cancelled plans to allow families to see each other over Christmas. And Brexit negotiators are still hung up over fishing. Talks between the UK and the European Union on a trade deal missed another deadline. There are a few signs that either side is ready to compromise. The two key disagreements are access to British fishing waters and limits on state subsidies for business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
I think that the administration's predictions that the general public will be getting vaccinated in the spring sounds optimistic from everything that I've seen. I want to be careful that we're not sending out messages that say that it will all be over by late spring. I think it will clearly take some months longer than that, probably into the fall.
That is the most important video we could bring you of last week. Atul Gawande, the president-elect's COVID task force, of course, out of Boston, really one of our premier medical officials across this nation. And that was the message, folks, I received in countless conversations last week, was the vaccine out into the summer and even into the autumn. Someone equally as expert on this, Mercedes Carnathon, is with Northwestern University in Chicago. I should say Evanston. They like to say Evanston, not Chicago. Excuse me, Professor. And joins us on preventative medicine right now. Mercedes, I want you to address to our public on radio and television how you have less of a fear of mutation, of variant, as we look at the United Kingdom this morning. How do you, as a pro in preventative medicine, treat the known that there will be mutations?
Yes, that's a really good point. You know, it is certainly scary to us and concerning when we hear about these mutations, especially when that message is coupled with news that it is spreading more rapidly. But we've known from multiple viruses over time that they do mutate. That's how they manage to stay alive. They've got to keep changing so that they can keep infecting people and preferably keep their stream of people as open as possible by even changing in the long run enough so that they can start to reinfect people. So we do expect this, but why it doesn't concern me quite as much is that the types of vaccines right now that are being developed can address that directly. They're different than the flu vaccine, which has to be repeated annually, and so they will. Right now, we still believe they'll be effective, even with mutations.
So there's a question about the vaccine, Mercedes, but there's also a question of just how long it will be before we can get back to normal. And given the schedule of the vaccinations, the fact that we've seen a little bit of a delay here in the United States, there's a question about supply chains with the recent lockdown in the United Kingdom. How much does this new strain of the virus prolong the pandemic as we know it currently?
Right now, there's no evidence to suggest that the current microRNA vaccines will not be effective against this new strain. And so I wouldn't say that that's likely to be the delay in our return to normal. What's going to happen, what the delay will be, is if our behaviors don't continue to hold the line on social distancing and masking. Because as you think about our vaccine rollout strategy here in the United States, we're first protecting the infrastructure, and that's the medical infrastructure by vaccinating healthcare workers, and then those with the highest risk of death, so individuals who are older or in nursing homes, but who we aren't vaccinating first are the people we think are the super spreaders. And so as long as that 20 to 39-year-old group is not being vaccinated, we think they're the ones who are spreading it. And so that's what's going to slow down our return to normal.
Mercedes, the success of smallpox, of rabies, of polio, do you place this tragedy in that group and that we can be successful with this vaccine and literally eradicate COVID?
You know, it's possible. However, doing so is going to require a global strategy. You know, I was reading concerning reports coming out of Africa coming out of other developing, out of the continent of Africa, and then coming out of developing world countries where they don't have a vaccine. Right now, they certainly don't have the ability to maintain a vaccine at negative 80 degrees Celsius, which is what's required of these two vaccines. And because of global travel, eradication is going to be hard if we don't focus our attention on reaching every corner of the world.
Mercedes, just quickly here, I'm wondering what you think of the schedule of the vaccinations as they've been laid out. Who is essential, and how quickly can they get vaccinated?
Yeah, no, I am pleased with the schedule, because I think protecting the infrastructure of healthcare workers who have to interact directly with patients who have COVID does need to be our highest priority. Next, we do need to address those who have the highest rate of death or poor outcomes. And so I'm pleased with that. I was also pleased over the weekend to see that essential workers were prioritized, those individuals who are educating our children, those individuals who are providing food and manufacturing services that cannot be done from home. So I do think that that is the right route. And if we can bolster the supply chain to get things out to as many people as who want this vaccine by late spring, early summer, perhaps by fall we can start to see somewhat of a return to normal.
Mercedes, thank you so much. Too short a visit today, just with breaking news. We've got to go. Mercedes Carnathon of Northwestern University in preventive medicine as well. We're anticipating a market turn, a retest of what we saw this morning. Lisa, not as grim as 6 a.m., but futures negative 71.
Yeah, and you have to wonder how much of this is just simply people cashing out of their positions after a pretty tremendous year. I mean, we are looking at a sell-off, but still, I mean, it's been a tremendous run since the end of October.
Yeah.
But there is a change in the feeling. There is concern about ongoing lockdowns. There's concern also about the fact that, okay, we got the stimulus bill, but is there going to be another one following it up?
Well, it follows on UK. I don't know. At least it's hard to take profits when you're in all cash. I mean,
You've been trying.
I mean, it's profit taking. It's there it is, profit taking.
When you keep asking, is this an entry point? It's actually a good question. I mean, it was perhaps less of a good question when you had more room to run. But now there's so many people saying go long into risk, and so is this? Well, that's the consensus heading into 2021. So if you see a sell-off like today, even if it's not that significant based on what we've been seeing over the past few weeks, do you go in? That's a big question, and that's what we're seeing certainly from the lows earlier today.
Negative 70 on futures. Dow futures negative 502. That's a 1.7% move. Pretty much correlated across the board with the VIX 8.01, 29.52. I would really underscore for those really getting attuned to the morning in America, this started in the United Kingdom with a major shutdown. It was tier 4, measured calm. At some point, maybe yesterday afternoon when the New York Jets were in the process of winning and winning big, but what we saw was a huge deterioration into the Sunday afternoon and Sunday evening in the United Kingdom, with essentially a shutting of airplanes, a shutting of the borders, a shutting of the train across the channel. Really, it is a United Kingdom on complete lockdown. And Lisa, we haven't heard much more on that right now. We're waiting really to hear from the Prime Minister.
Frankly, I'm just curious about the timing of this, because if they saw this coming at all, why did they do it all of a sudden to send people rushing home? You saw crowded train stations. I think
it's been that sudden.
But all of a sudden they locked it down, and then people rushed to get together and get into trains. You just wonder the logic of that.
I think the virulence of this second mutation has caught everybody by surprise. Maybe we'll have a look at that over the next coming days. So futures at negative 68, Dow futures negative 488. More data checks through the day across all of our Bloomberg platforms on the American economy. Megan Green, we do that next. This is Bloomberg. Good morning.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
Good morning, everyone. Bloomberg Surveillance. Thrilled to have you with us here. Lots going on. At the 8:30 hour, we can look at the economic data through the week. It's going to be an interesting week for truncated economic data, but this morning it's all about the markets. Futures negative 65, Dow futures negative 464. In the bond space, it's just what you'd expect, correlated with price up, yield down 0.8965 on the 10-year. The dollar weakness finally gives up with a sharp reversal of dollar strength. I guess we saw it coming, but there it is. And again, the news here is extraordinary out of the United Kingdom, where they are simply overwhelmed with a mutation, a variant of the COVID-19 virus, and there is a shutdown of the United Kingdom with all other nations reacting. One of those best qualified to speak on this is Megan Green, with her time in the United Kingdom, now at the Harvard Kennedy School, and a senior fellow there as well. Megan, with the news of the virus, the stimulus has just been subsumed as well. And am I reading how quickly it will all end? Do you just assume it's almost a stopgap stimulus till we get out to March or April or May?
Yeah, so the stimulus package, Tom, was always meant to bridge to the other side, and the other side is the vaccine, which thankfully we have a lot of good news on, though I do think this new contagious strain in the UK does raise questions about how quickly this virus will mutate and whether the vaccine, will be effective on it, how often we have to update the vaccine, all those things. But this stimulus really is a stopgap. It's come really late, and it's a little lame, honestly. It's not as big as I would have liked, but it's better than no stimulus at the end of the year at all. If we had waited until the new administration had come into power, particularly if the Republicans control the Senate, then it probably would have been even smaller. So I think this was probably the best that we could have realistically hoped for.
Do you expect that policy will be committed within the Biden administration? I know you're going to say we got to wait to see the Georgia elections, plural. I get that. But are you optimistic about policy, or will it be gridlock as seen for years?
So I do think the Biden administration is committed to both managing this virus, containing it as a top priority, and then to building back better, so taking a more medium-term outlook, so not just filling in the hole that we all fell down when we shut down our economies this year, but also looking towards how to upgrade the labor force, how to fundamentally retool our economy for sustainability, those kinds of things. But the Biden folks are coming in. They had a really ambitious spending plan, and I think that will be significantly curtailed. So things like healthcare reform, tax reform, that's going to be a lot harder now than it would have been if there had been any kind of significant majority in the Senate, particularly for the Democrats. But whoever wins in Georgia, it's going to be a razor slim majority. So that will mean that, the Biden administration can't do everything it wanted to do.
So, Megan, you said that this fiscal support bill was a little lame, which I imagine is high-level CFA speak. But there is a question of the efficacy and the directness of this support. support, do you call it little lame simply because of the size, because you'd like to have seen it be bigger, or is it because of the type of support being delivered?
So both because of the size, I think it should have been somewhere between 1 and 1.5 trillion, and it's below that clearly, but also because it left out any kind of real direct support to state and local governments, though it did offer some indirect support in terms of education, virus measures, also testing and tracing. But they were generally pretty small. I mean, they devoted less money to testing and tracing and the vaccine than they did to the airlines, although the airlines, to be fair, was for kind of payroll support, so it's not useless, but I'm surprised by how little was actually devoted to the virus itself, because unless we can actually contain this virus, we're just going to keep having to do this over and over and over again, passing stimulus after stimulus. So go ahead.
Well, no, I mean, this is such a politicized point, this question of what's the best source of, or what's the best method of financing here? Is it to give direct payments to individuals and households, or is it to give money to state and local governments? And it's been so highly politicized because Democrats have been for that state and local funding and Republicans have been adamantly against it. Yet economists have come out also pretty much on either side, with some people saying direct infusions into lower income households is a very direct injection of cash into the economy, and others saying that state and local governments need it more. Where do you weigh in on this debate?
I think we should have done both. Look, real borrowing costs are negative. The markets are begging the government to borrow. The Fed is begging the government to borrow to fight this war. So I think the answer is we shouldn't have felt so constrained in the size, and we should have allocated money to both. But policy is generally a question of trade-offs. And so, I think in this case, it was inappropriate that we felt we had to accept some trade-offs. I think we could have funded both. I think another really interesting point in this is the reaction to the Fed's facilities. I think the Fed has got to be worried about its own independence now, and it's clear that the Republicans are going to be attacking the Fed throughout this administration. So I think that's a concern as well.
Well, let's rip up the script here, folks. I was going to go 3 other ways with Megan Green, including Red Sox baseball, but this is more important than Red Sox baseball. Megan Green, it's another shot at the Fed independence. How does the Fed defend itself against the battle of independence? Back to McChesney Martin.
So I think the Fed has to be creative in this case in particular. If the Fed can't provide the same kind of cookie cutter programs, then it's just going to have to innovate more. But in an era when central banks globally are trying to not be the only game in town, and they're asking fiscal authorities to step in, if fiscal authorities don't step in, the reality is that central banks will have to be the only game in town. And to do that, they're going to have to do really unorthodox things. We've already seen that happen in Europe. The ECB is offering TLTROs, which are subsidies to the banks. And so, we're going to need to see central banks innovate, and that's going to be a lot harder for the Fed in particular, and the Fed's going to be much more sensitive to moving into fiscal space if the Republicans are constantly taking shots at its independence.
And we're going to rip up the script twice with Megan Green. We rarely do that except with Megan Green, and that is Russia with the headline out, looking for an output lift on OPEC as well. Brent crude reacts a little bit. We'll see above 50 and it goes down. I don't want to overplay the movement here, but Megan Green, my book of the year, Daniel Yergin, The New Map. And it's real simple. He talks about the new map of OPEC, the new map of Russia, the United States, Saudi Arabia, and the rest. Does oil politics matter anymore in your world, or is that a legacy of another time and place?
So matter for who, I guess, is the question. It matters less for the U.S. now that shale production means we're a net exporter, but it still certainly matters. We saw that in March when oil prices started going negative, kind of what it did to the markets, and also what it started to do to the oil patch. It started to prompt much more consolidation. So oil certainly matters, but less for the U.S. than it did one.
Yeah. Lisa, why don't you jump in here and please rip up the script for a third time. We might as well do that. It's a hat trick.
I'll rip up the script for a third time. Let's talk consensus, and consensus being turned on its head, because that's really been the theme of today. This question of whether a blip in the markets, a blip in sentiment really calls into question the consensus that has been so dominant. In the economics world, the consensus is that next year will be a lot better and that we'll continue to grow and potentially start to grow out of the pain that we saw in 2020. Where are the cracks in that consensus, Megan?
Yeah, so I've got to say I've never seen such an overwhelming consensus among economists going into a new year. And so I agree with the consensus. It's hard to disagree that there will be pent-up demand released next year off the back of a widely distributed vaccine, hopefully. And that should drive equities higher, bond yields a bit higher, the U.S. dollar lower. I think the major potential shortfall of that is that inflation could pick up. And I actually will die on this hill. I don't think inflation will pick up, but there is a chance that as you get pent-up spending released, you could end up getting a small uptick in inflation. If you ended up having central banks feel like they had to hike into that, then a lot of leveraged companies and a lot of countries in EM will get into big trouble. And so I think that's the most vulnerable point in that consensus view.
Megan Green, thank you so much. The Harvard Kennedy School senior fellow with us this morning. I do want to point out, folks, massive data here. It's a holiday lengthened work week where you've got the December 24th, Christmas Eve, where, I'll begin my Christmas shopping. And what happens is you don't get the data dump on the 24th. You get the week's data dump on the 23rd. So Wednesday is the key data day. 22 is busy tomorrow, but then 23 is just extraordinary as well. I guess, Lisa, a new breath here. Futures negative 59 is a lot better than 20 minutes ago and 2 hours ago.
Yeah, I really want to pick up on a number of things that Megan was talking about. One of them, this question of the central bank independence. I mean, I feel like we've glossed over this, Tom.
Yes, we have.
This has been one of the biggest hang-ups on the fiscal support package was this clause limiting potential Fed action similar to what they took earlier in the year to try to spur lending to specific businesses, really raising questions about what the parameters will be. And yes, that has been dialed back in the language, Tom, but it raises a battle that really we'll see next year with respect to the Republicans versus the Democrats and how much leeway the Fed has to really battle any surprises negatively to the economy.
Well, the threats that they've seen have been tangible, and they've sort of defended themselves, I think, pretty well. It comes down to messaging, but also really the legislative branch coming to the defense when things get tested, and we've certainly seen that today. On dollar dynamics, Lisa points out a stronger dollar on blended DXY, 90.44. It's a little bit of a lift now off of what we've seen. Euro 122 doesn't give back. It's stronger euro here in the last number of minutes. This is really interesting dynamics, actually, with sterling 133.18. Lisa, what's credit doing? I mean, it was super, super tight, right?
Yeah.
They were really right down there. Has it moved at all?
No. In a word. I mean, it's basically just more about, basically there's an incredible bid. Some people have been taking some, cashing out of positions or whatever, but for the most part, people plowing into risk and seeing credit as a place to do it.
Well, again, an historic day. Lisa Bramwitz and Tom Keene, we continue through the morning as well, again, with futures at negative 60. Coming up, Penny Goldberg will join us with the Peterson Institute with their wonderful heritage of working with the World Bank. Penny Goldberg here on some of the nuances, societal nuances of this terrific pandemic. Again, for those just tuning into the zeitgeist, the United Kingdom essentially in lockdown. Futures at negative 59. This is Bloomberg. Stay with us.
With the First Word News, I'm Rishka Gupta. Lawmakers won't have much time to review a $900 billion economic stimulus plan that congressional leaders have agreed on. Both the House and Senate are scheduled to vote on it today. Most Americans would get a one-time $600 payment. There would be $300 a week in enhanced unemployment benefits through March. And the Paycheck Protection Program would get $284 billion. That includes forgivable loans for small businesses. U.S. officials acknowledge there will be a lengthy effort to determine the extent of a suspected Russian hack on federal agencies and private companies. Republican Senator Mitt Romney says Russia acted with impunity, and he says President Trump has a blind spot about it. The president has contradicted U.S. intelligence officials and suggested that China may be behind the cyber attack. And President Trump's campaign is turning to the Supreme Court again to challenge the election result in Pennsylvania. It's filed another long-shot appeal aimed at overturning 3 separate decisions from Pennsylvania's highest court. The Supreme Court has already rejected 2 efforts to overturn Joe Biden's victory in pivotal states. Elon Musk has inquired about converting large transactions of Tesla's balance sheet into Bitcoin. Musk had an exchange of tweets with a prominent boost of the digital currency, Michael Saylor. Saylor urged Musk to shift US dollars from the electric car maker to Bitcoin. He said Musk would be doing shareholders a $100 billion favor. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
How have you changed as a leader since that day in 1993 when you joined Roche?
You develop over time, and it's a series of experiences which hopefully make you a better leader.
Support is unequivocally beneficial. If you think about where we started in March when COVID hit our shores and where we are now, it's really remarkable that the economy has done so well.
The gentle lady from San Francisco, Mary Daly of the San Francisco Fed. Sometime look at her biography. It is an extraordinary story of grit and determination as well. Lisa, you're looking forward to the Open, a property of John Farrow. I guess he's not here. John who? Yes. Who do you have on the guest today? I mean, you must have, the walls must have been breaking down to be on the Open with Lisa Abramowitz.
Yeah, everybody was trying to get in. No, not at all. People all miss John Farrow. Tony Dwyer joining us, Canaccord equity strategist. I'm really curious to see whether this is a viable dip, one of the questions, or whether we see more pain going forward as people reassess the optimism currently baked in.
I'll give you a hint. Dwyer named his 48-foot Grand Banks by the dip, so that's all you need to know.
All right, thanks. Stay tuned.
As well. Right now is a joy, and this is a joy with Janet Yellen taking over as Secretary of the Treasury, or for those modestly younger like Mary Daly or maybe Susan Athey as well. Penelope Kuanu-Goldberg has been definitive in economics. It goes back to her tenure at the American Economic Review, her tenure at Yale University, and her public service to the world at the World Bank recently for Dr. Kim and Mr. Malpass as well. Penny Goldberg joins us this morning from Yale and the Peterson Institute for International Economics. You pride yourself, Professor, on applied economics. How do you apply economics to a natural disaster like a pandemic?
That's a very interesting question. So the pandemic was truly novel. It was something unprecedented. So that means we cannot take off-the-shelf models or techniques and apply them to the pandemic. What we can do as economists and as scientists more generally is apply the wisdom we have accumulated over the years to this particular situation. So apply a certain way of thinking about the problem. And part of this also involves looking at the evidence very carefully, following the evidence.
Part of the applied is the run rate back to normality. Do you have the x-axis? Do you have a run rate of when we get back to normal after a vaccine? Is it 1 or 2 years, or are you like, say, Olivier Blanchard, where it could be a much longer line back to normality?
So I'm very hesitant to make any predictions because the one thing we learned in the past year is that everything is uncertain. But I think it's a long way, it's a long road ahead. I do think that by the end of 2021, we'll be in a much better place. So the pandemic will be on its way out. It will have played out, but we will still have to deal with the economic fallout. And the consequences are going to be felt in the long term. I don't think things will return to normal very fast. I think we'll have recovery for sure. But I think it will take a very long time before we have a sense of normalcy again.
Do we recover by growthing our way to recovery, or do we recover with a higher tax burden?
Growth is going to be an important part of the equation. I don't think raising taxes is a short-term priority. Eventually, we have to deal with the fact that we have an enormous debt, and this has to be reduced. But I don't view that as a priority in the next few months.
In the time that I've got left, Professor Goldberg, I must speak about your sterling career and the great frustration of more women in economics. I would suggest economics is, quite frankly, leading the way with academic acuity. How do we get more women involved in the evil science?
Well, first, let me say it's getting much better. So by now, there are more women at every level. So it starts very early. So if you look at what happens at the undergraduate level, we have fewer women than men, even at that level. And then then you go to the graduate level, again, you have fewer graduate students, female graduate students than male graduate students. So, and at every stage of a career progression, we lose women throughout an academic career. So I think this has to start very early. It has to start at the high school level, perhaps at the undergraduate level, encourage women to enter economics, not because they have to. Everyone has to follow their dreams and their talents. But I do think economics offers very good careers, and I think women have a lot to offer. So they shouldn't shy away from it because sometimes they have a wrong conception of what economics is about. So I think this has to start early on. And then as we move through a woman's career, we have to make sure that at every stage of the process, we don't lose women. One of the main issues is in economics, you tend to peak in your career in your 30s or in your 40s, that's when women have children. So that's always been a very important issue. So making sure that women don't retreat because they have to take care of the family, this is important.
And child care mentioned briefly in the stimulus bill that we saw over the weekend. This has been a joy. Penny Goldberg, we would love to have you on again. Penelope Kiwana Goldberg of Yale University and the Peterson Institute here on COVID and some of the applied economics that we will see for it. It has been an extraordinary day. We want to make particular thanks to all of our United Kingdom team for some real wisdom through the morning. Many of our staff on severe lockdown in London with a skeleton crew at Queen Victoria Street. We greatly appreciate their efforts. The news without question today is the lockdown of the United Kingdom. Maybe it's not a total lockdown, but there it is with the airlines, with the rails, and with shipping as well. It'll be interesting to see overnight what we see out of the Prime Minister's COBRA meeting as well. In the United States, stimulus celebrated. We'll have much more on that through the day, including David Weston, Balance of Power. Look for that at 12 noon. But I'll tell you, folks, the stimulus is, David Wessel was out on Twitter, the wonderful gentleman from Brookings Institution, and he said, "Excuse me, is there a printed copy?" And I'm not sure, David, that there is a printed copy. Look for that in January or February as well. $900 billion, second largest stimulus, I believe, in American history. Much more on this. Kevin Cirilli, of course, watching the story with our team in Washington. You deserve a data check. It's way better than it was early this U.S. morning. We were negative 100 on futures. We rebound down 1.6%, negative 61 on futures. The VIX goes out 7 big figures. That's extraordinary. We were out well over 30 earlier, but at 28.84. That's a real elevation, I should say, of volatility over the last number of hours. 2-cent spread comes in 3 basis points. Yield 0.9081 on the 10-year yield. I do want to make note of oil, particularly the Russian headline out moments ago, $50.23, down $2, down 4% on Brent crude. That gets my attention as well. And then, of course, we've had a reversal of the weak dollar, strong EM view. We'll see how that plays out here on television. Anthony Dwyer will be on with Lisa, what's her name, Megan? Lisa Bramowitz. Yes, thank you, Megan. Lisa Bramowitz and Anthony Dwyer coming up from Canaccord on the markets. Mark Kiesel of PIMCO. This is Bloomberg. Good morning.
新型にはなんと2万点以上前進でついてます。なので2万点あることにより、その情報が取れない、平面がないんですね。なので全てをスキャンすることができるので。どちらにせよ自分のサイズを一回最初から、適正なものを発見してそれを買って、家に届いてきたらぴったり非常にハッピーというのがやっぱりしかるべき姿かなと思ってます。 ます。
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
For our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. The countdown to the Open starts right now. 30 minutes until the opening bell this morning. We begin with the big issue, a new virus strain weighing on global markets.
The briefing that I had yesterday about this mutation of the virus, particularly about the speed of transmission, was not possible to ignore. And when as I say, when the virus changes its method of attack, we as a country have to change our method of defense, and that's what we're doing.
The UK Health Secretary echoing the Prime Minister, painting a grim picture, saying, quote, "The new variant is out of control and we need to bring it under control." And this news about the new variant has been an incredibly difficult end to, frankly, an awful year. Countries around the world closing their borders as European nations suspend trade links with the UK. Fears of the fast-spreading mutation forcing London into full lockdown, but the US brushing off travel concerns, keeping its door open.
Viruses mutate. We've seen almost 4,000 different mutations among this virus. There is no indication that the mutation right now that they're talking about is overcoming England.
This is the World Health Organization warns it could take over a week to determine how the new strain responds to the vaccine.
It's going to take, a couple of days, if not a week or more, because there are several experiments that need to be run. And because this is it's such an important question, it needs to be addressed properly.
The virus casting a long shadow over risk assets, with pressure mounting on Capitol Hill to pass a $900 billion relief package before lawmakers leave town. Joining us now are Bloomberg's Guy Johnson and Kayleigh Lyons. Guy, let's start with you. Can you give us a sense of what brought about this sudden reversal, this immediate lockdown that got implemented over the weekend in the UK?
The details started to emerge kind of the middle of the way last week, Lisa, that there was a new strain. By the weekend, it was clear that this new strain was basically causing a huge pickup in the number of cases in the UK. The new strain, much more transmissible, and as a result of which the UK government was required to make the changes that it made over the weekend at incredibly short notice. It is unclear at this point whether or not this new strain is elsewhere. The UK does around 50% of sequencing worldwide, as a result of which it may have just been a bit more nimble in terms of determining that this new strain was around. But certainly the pickup in cases was a fairly solid clue that a new strain was in operation and is likely to become the more dominant strain. As a result of which the UK took the decision over the weekend, the UK government took the decision over the weekend that it needed to shut down, particularly the southeast of England, where the new strain was most prevalent, as a result of which London and the surrounding areas were put into a Tier 4 lockdown, which is effectively a full lockdown just before Christmas, a hugely difficult decision for Boris Johnson to make. What then followed was a series of decisions on the continent, and as you were alluding to, around the world, that the UK needed to be put on a new list, and effectively countries as far away as Hong Kong and Canada have decided to do that. There are huge queues down at the ports. We have seen that 48-hour restriction being put on by France. So yes, there's a great deal of concern here as to what is happening, and there have been queues at supermarkets being caused by concern that people need to stockpile, Lisa.
All right, Guy, just real quick, how much criticism is the UK government coming under for not taking action quicker and then taking the action that it did, leading to people to crowd train stations?
I think there is always going to be a lot of criticism, particularly when we are in such a heightened state. I've listened to various politicians this morning on both sides of the aisle. I think there is a recognition that this is a new strain of the virus, that it has been determined relatively quickly. I think the way in which the government has acted, there probably was an opportunity maybe a little earlier on to take action, but certainly it has been the increasing cases over the last few days that has been forcing this decision. I guess when the facts change, maybe the decision-making process around that will change as well. Yeah. But certainly, I think the approach and what we saw on Saturday and Sunday, there has been some criticism that the government could have acted sooner.
Guy Johnson, thank you so much. And we're still waiting to hear confirmation that the vaccines currently in development will actually be effective with the new strain. That is the belief. And the European Medicines Agency did recommend that the Pfizer-BioNTech vaccine be used in the European Union. So a step forward in getting that rolled out there. Meanwhile, Bloomberg's Kaylee Lyons has been checking out all the market reaction to the lockdown in the UK. And of course, Brexit concerns. What are you seeing, Kaylee?
Yeah, a lot of risk out there, Lisa, and that is weighing dramatically on risk appetite this morning. You've really seen fear come back into this equity market. What's going on in the UK underscoring the worsening near-term virus trends and the risk of further lockdown. Stocks in Europe broadly lower. The DAX down a full 3 percentage points. The FTSE 100 over in the UK nearing those level of losses as well. Here in the US, we are looking at a softer open. Though futures are off the lows of the session, the S&P 500 futures still down around 59 points, and the Russell 2000, the relative underperformer here, futures lower by around 2%. And investors really fleeing equities, Lisa. They're looking for safety elsewhere, specifically in the bond market. We're seeing yields, gilt yields come in around 6 basis points here in the U.S. The 10-year yield, not that large a move, but it is coming in around 4 basis points, 90 basis points where we print at the moment. It could be one of the biggest gains for treasuries in about a month. You're also seeing a haven bid into the dollar up about 0.7%. So much for that weak dollar story, Lisa. It is stronger against everything in the G10 space this morning. What is not stronger, however, is oil. Brent down a full 4.5%. This morning, below that $50 a barrel threshold. A lot of concern about what further lockdowns could do to oil demand. There's also a lot of concern about what it could do to the travel sector and really the broader reopening trade. That is not in favor this morning. We're seeing stocks like United Air and and American Airlines poised to open between 4 and 5% lower. Cruise stock Carnival down more than 6% in the pre-market. Expedia lower as well. You do not want to be anywhere close to that reopening trade this morning, Lisa.
Kaylee, thank you so much. Meanwhile, Canaccord's Tony Dwyer seeing a market ripe for correction, expecting renewed COVID-19 fears over a new virus strain to offset euphoric sentiment, or at least sentiment that was euphoric before today. Tony, there is a question here whether this dip is buyable or whether it's the beginning of deeper pain ahead for markets.
Well, first of all, happy holidays. It's great to be with you everybody. Yeah, so we've been looking for a correction since really the middle of November. And actually, if you look outside of the small cap Russell 2000, in some of the favorite areas that we have, the cyclical trade, the market has actually been consolidating a bit. As an example, the percentage of stocks above their 10-day moving average for the S&P 500 has dropped from over 90% in November to currently 50%. Now it's going to obviously be lower today. So we've been we want to, because of the macro backdrop, we want to buy into weakness, not fear it. The euphoric sentiment has just gotten so extreme that it was an environment that was ripe for an out-of-nowhere news item, and the UK strain of COVID-19 is providing that news item.
But Tony, you can see that other people have the same idea, and frankly, people who come on the show again and again have said they're waiting to buy the dip. I mean, is this enough of a dip to buy? It seems like that's what people have been doing, at least if you look at the early morning weakness that has since improved over the few hours.
Nope, not yet, Lisa. We wait for the data versus what we quote unquote think. I mean, Wall Street's famous for coming on and telling you corrections are natural, normal, and healthy until they actually happen. And then when you get one, by definition, because it's going down, it's got to feel like there's something fundamentally driving it, and they don't want to buy it. The macro backdrop of strong credit, excess liquidity, a synchronized global recovery, we want to buy once it's there. And again, it's not there. Similar to the September swoon that we had. Remember, the S&P was down 10% in September. It was down again 10% from peak at the end of October. And we could have another 5 to 10% drop from peak, and we're working our way there. And that's where I think you want to remember that you do have this synchronized recovery, and it's driven by an excessive amount of liquidity.
Well, but Tony, there's a question of what could be enough of a catalyst to give people that sense that perhaps this time is different, and any decline in equities really is on the heels of true fundamental data. Right now, we're getting a headline that Nancy Pelosi, House Speaker, is saying that the stimulus checks will be going out soon. I mean, this liquidity isn't stopping, and we have already a deteriorating economic backdrop with respect to claims and other economic data. What will be enough to change the backdrop fundamentally enough to get the sell-off, the correction that you're talking about?
Quite literally, I think it's very little. If you shut down the world again to how you did it in March, I think that would do it. Or you would get some kind of unforeseen spike in inflation and therefore interest rates that would shut down corporate credit. That just doesn't seem to be the case. Again, the government is trying to bridge the gap until we get the vaccine. And this weakness in economic activity, it's been rolling weakness for the last month. So I don't think that anybody is surprised by the weakness. Of course, when you have a historic level of optimism, the first sign of a problem is going to bring about that fear, and you're seeing it in the CBOE volatility index. Right. But again, when the market is whooshing, that's the time. As long as you have this excessive liquidity backdrop, which we will. As long as that's the case, when it's whooshing, it's a technical term, that's when you want to look to add into those areas that you wish you bought 5 to 10% ago, but didn't.
Well, so Tony, talking about whooshing and all of that liquidity, let's talk about that $900 billion stimulus plan that's probably going to be passed later today. What's your take on it? Is it enough to keep the markets going up, or is it enough just basically to satisfy what already was baked in?
It's not enough to keep the markets going up today. Should it be enough for the next 6 to 12 months? Probably not even then. You'll need another package. Remember, it's 11 weeks, and it's unlikely that you're going to have the population vaccinated within 11 weeks, which is why the Biden administration or incoming administration is talking about another package once he gets into office. So, again, but it's not the exact amount of money that I think is the most important. It's the willingness to provide liquidity when it's necessary. D.C. has been horrible at that until just now. They were great up front in March and April. That was extraordinary, the coordination between the Fed and the government and the administration and Congress to get the needed stimulus that's out there. Now we have the second round of it. We'll probably get a third round of it. As long as the willingness is there for that, weakness should prove temporary. Where you get into trouble, economically and in the market, is when you have a need for money and little or no access to it. There's a historic amount of money that has been made available since the March pandemic began.
Tony Dwyer, thank you so much. Happy holidays to you and your family, and be well. We'll see you in the new year, no doubt. Right now, Bloomberg's Abigail Doolittle joins us. I will get my words out with a look at the stocks moving ahead of the opening bell. Abigail, what you seeing?
Well, Lisa, it is certainly a risk-off tone today. The S&P 500 futures, as you know, heading perhaps to their worst day in almost 2 months. So one big drag. Tesla now to be included in the S&P 500 down in the pre-market. Sell the news action. Not such a surprise probably to some experts, down 3.4%, because on the year up more than 700%. So sell the news here, really not that big actually in the perspective of those huge gains. As for the risk-off tone, the reflation and the reopening trade is off. If we take a look at this areas most sensitive, you see that the airlines are trading lower. You also see that the cruise line operators, Boeing, all down. Investors want out of that cyclical trade, at least today, Lisa. Let's see whether or not that lasts. But again, today the mood is risk-off, and we're seeing those sorts of movers, those reflation movers selling down.
Abigail Doolittle, thank you so much. Coming up, the pressure is on in D.C., Congress voting on a $900 billion pandemic relief package. That conversation up next with Eric Knudsen of Neuberger Berman. In the markets, we are seeing that risk-off tone that Abigail was just talking about as people assess the potential for a new viral strain, although very much off earlier lows as people come in to buy that dip. We can see also that the NASDAQ is performing better as people reassess the stay-at-home stocks. We've got more coming up. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We've agreed to a package of nearly $900 billion.
Late last night, the logjam was broken.
More help is on the way.
Let's get the job done, together, for the sake of the American people.
Both sides and both chambers have really stepped up and worked hard to get this done.
This compromise should not have taken as long as it did.
Senate Republicans were advocating for a package just like this one all along.
The time has come to move forward and reach a conclusion.
There'll be another major rescue package for the American people.
When this chamber gavels back in 2021, we must pick up immediately where we left off.
Congress reaching a bipartisan agreement on a $900 billion fiscal aid package. That bill will be hitting the floor in both the House and the Senate later today as Congress prepares to vote on the second largest economic rescue measure in history. Bloomberg Chief Washington Correspondent Kevin Cirilli joining us now with the latest. Kevin, can you give us the details as we know it right now?
Let's start with the policy, Lisa. The $900 billion stimulus includes $15 billion to reinstate payroll reimbursements to airlines, $10 billion for state highways, $2 billion for airports and airport concessionaries, $1 billion for Amtrak, and $284 billion for the Paycheck Protection Program and $600 checks to most Americans, in addition to the $300 in extended unemployment benefits. That's the specifics in terms of the policies. What is still left to be hammered out includes, though I'm told by a Republican aide this morning, the details surrounding the Federal Reserve lending facility programs. I'm anticipating that we'll have some more clarity on that particular issue within the next couple of hours. Remember, the House of Representatives, from a political matter, third and lastly, is set to vote on this no sooner than within an hour, but sometime today, mid-morning, early afternoon, or maybe even in the evening, but sometime today is when the House is expected to pass this.
Thank you so much, Kevin. We'll be catching up with you later. Eric Knudsen of Neuberger Berman stressing the need for an additional stimulus package, writing, quote, government spending significantly offsets deeper private sector contraction. Additional fiscal policy develops, including extension and expansion of small and medium enterprise support measures, as well as possible outlines of an infrastructure program, that ever elusive infrastructure spending. Eric joining us now. Eric, what do you think so far of the preliminary bill as we've seen it?
Well, good morning, and thank you for having me, and wishing everybody a happy and healthy holiday season. The bill as we see it is, I think, kind of table stakes. It's what the markets have been expecting, this $900 billion level, the focus on some income replacement, some extension of the unemployment insurance, and some extension of the PPP package. All of these have been, effective and well understood, pushing off some of the more challenging aspects from a political standpoint in terms of state and local aid and liability. And so I think that this is largely priced into markets, and that's partly what you're seeing today with a bit of the sell-off is, sell the news after having bought the rumor. I think it's important to note that even with this $900 billion package, which is a meaningful percent of GDP, that with this, the fiscal impulse for 2021 is still slightly negative because you're still rolling off multiple trillions of dollars of spending in crisis relief from 2020. So I think this is table stakes. I think this allows markets to kind of move forward from here and begin to focus on what will be the true drivers in 2021.
Okay, so what will be the true drivers? I mean, basically, if you're optimistic and you're looking toward a better next year, if you're with consensus and are betting on risk assets, you have to believe then that there either is going to be a quicker end to the pandemic or there's going to be more fiscal support. Which is it?
Yeah, you've highlighted it. The consensus right now is very well established that 2021 will be a better year than 2020. It's hard not to, and that by mid-year we'll be in the midst of early cycle dynamics, higher economic growth, higher earnings, lower unemployment, likely higher prices, and constructive monetary and even fiscal policy environment. The problem for us is that's well priced right now, and that in order for equity markets to move higher from here, you either need to see rates go lower, which we don't think is likely. Rates are already pretty low, or you need to see evidence of earnings growth. You need one of those two. You're not going to get both at this driving markets higher at this point. And so, we do believe we need to see a pullback like what we're seeing inklings in headline equity levels. And in the meantime, it's not about just taking on more equity risk on a very short-term basis. It's about finding where the attractive areas are global equity markets.
So, Eric, on a day like today where we're seeing a bit of a pullback, nothing that significant, but still more than we've seen recently, is this a buy the dip moment, or is this a harbinger of what we're going to see?
So we would buy, if we were down another few percent, we've got actually a risk reversal trade on at 3,600, so that's an interesting entry point. But we need to see some additional sell-off coming into the new year. One of the historical analogs we've been looking at is the 09, 2010 environment. Many folks have forgotten that going into 2010, we had a very, very similar setup as we have right now. Going into 2021, we're coming off a severe contraction. There's massive stimulus in the pipeline, and I think people going into 2010 were similarly optimistic. What folks probably forget is we got some pretty significant volatility volatility in the first half of 2010, so some 10 to 15% drawdowns before that year ultimately ended up 15% on the S&P. And I think that investors need to bear in mind the likelihood, in our view, of significant volatility in the first part of 2021 before we get that true early cycle setup that can lead to improvement in risky assets in the second half of 21.
Eric Knudsen, thank you so much for being with us. Coming up, the analyst action you need to know. That's next in our morning calls. And later, the safe haven trade getting a bid with new virus curbs weighing on global stocks. That conversation up next with JP Morgan's Phil Campriali. I'm Lisa Abramowitz in for Jonathan Farrow, and this is the Countdown to the Open.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
I'm Lisa Abramowitz. This is the Countdown to the Open. Right now, we are looking at an S&P off earlier lows, down 1.4%. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, RBC Capital Markets upgrading Walmart to outperform. The analyst citing improving profitability. Next up, Morgan Stanley raising its price target on Disney to $200 from $175. The analyst citing strong secular growth, exposure to advertising, and the reopening trade as catalysts. And finally, Citi upgrading Microsoft to a buy, raising its price target to $272 from $229. The analyst expecting a stronger 2021 forecast for its Azure cloud computing business. Coming up, futures sinking on renewed virus fears, although off earlier lows. JP Morgan's Phil Campriali joining us at the opening bell on the search for safety, or perhaps search for yields. That conversation still ahead. The opening bell up next. This is Bloomberg.
Chinese brands now account for 7 of the country's top 10 cosmetics lines, up from just 3 in 2017. That has pushed out foreign brands like L'Oreal's Maybelline, which has seen its share of China's makeup market plunge by half since 2010. For more, we're joined by Bloomberg editor Bruce Einhorn. Bruce, why the drop?
Chinese brands are becoming much more adept at reaching Chinese consumers, especially now at a time when more consumers are reluctant to go shopping outside. People are spending more time at home. People are spending more time on social media. Chinese brands are very good at using social media, using live streaming, using other things in order to market. Chinese brands also tend to be less expensive. And so at a time when the economy is struggling a bit, there's a lot of uncertainty, people are more budget conscious, Chinese brands have a bit more of an advantage.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
And there you have it, the opening bell opening on a down note, but off earlier lows with the S&P down 1.3%. The Russell underperforming, perhaps a bit of a reversal from that rotation into cyclicals as we look at a worsening virus, a new strain, and possible new lockdowns. Welcome back to Bloomberg The Open. Jonathan Farrow off today. Let's head to the markets desk. Bloomberg's Abigail Doolittle joining us now with some of the initial movers. Abigail.
Well, Lisa, we certainly have to talk about Tesla because we do have this risk-off tone, and a piece of it could be Tesla because Tesla is now part of the S&P 500. The stock is trading lower on its first day of being included in the S&P 500. Not a huge surprise to some, though. A number of the volatility experts who join us on Options Insight have suggested that this could be a sell the news moment, specifically because the stock is up more than 700% this year on the fact that it would be included in the S&P 500 and that indexers would have to buy it. However, you've been mentioning the risk-off tone relative to the virus mutation, the increased UK lockdown, and fears that this sort of situation could move elsewhere. So let's take a look at some of the reopening movers because they are down today. American Airlines down 5% on the idea that perhaps folks will not be getting back on planes as fast as traders had hoped. Occidental Petroleum, that energy sector, really getting hit, down 8%. On the other hand, the stay-at-home trade, Zoom, up 2.2%. And then we also have CureVac, which is in phase 3 for its vaccine, also higher. So we're seeing a reversal out of that cyclical trade. And this actually started last week, Lisa. Those cyclicals had sold off. And now today, again, we have some of the reopening movers down and the stay-at-homes higher.
Yeah, questions about whether momentum had gotten ahead of its skis. Abigail, thank you so much. Meanwhile, stocks tumbling at the open as renewed virus fears weigh on markets. MKM's Michael Darda recommending investors take advantage of the pullback.
The way investors should treat these pullbacks is, not to go crazy with any, one-day movement, but to gradually be leaning in if you do have some cash in the portfolio, but not across the board, not in tech, comm services, consumer discretionary, but in those value-based sectors and in reopening trades. So I would do it gradually. I would do it on a day like today for sure.
That was Michael Darda hanging out with his dog on this day and saying, please just moderate your risk-off feel. Bloomberg's Kaylee Lyons joining us now with more. Kaylee.
Well, Lisa, we may already have seen some of that buying come in that we are off earlier lows. Nonetheless, it is a red day, red all across my screen. All of the major averages down in the ballpark of 1%. Again, not as dramatic as the losses we were seeing in the future session, but still definitely a risk-off day. The Russell 2000, really the relative underperformer that we know is a more cyclically oriented reopening kind of trade. That's not happening today. What is happening today is a bid for safe havens. Interesting, as we're seeing the yields, equities kind of come off the lows, yields are actually losing some of their steam as well. The 10-year yield now down just around a basis point, 92 basis points where we sit. We are still seeing a stronger dollar, though again, not as much strength as we saw earlier. Where we are seeing a decent amount of strength is in bond, in financials, however, broadly stronger this morning. JP Morgan, Bank of America, Morgan Stanley, Goldman Sachs, all rallying in the neighborhood of 2 to 3% this morning. You can thank the Fed for that. Regulators deciding banks will be able to buy back as much as $11 billion of their own shares in the first quarter of next year. Of course, those have been prohibited since June, but both JP Morgan and Morgan Stanley put out statements saying they will resume those buybacks starting next quarter. Citi, Goldman, Bank of America all indicating something similar as well. The prospect of those repurchases really aiding those stocks this morning, Lisa, but as I said, otherwise it is broadly a get it out of risk, get into safe havens kind of day.
Kaylee Lyons, thank you so much. Joining us now is JP Morgan's Phil Camporelli. Phil, I got to look at a day like today, and now we're down just about 1% after being down 2.5% in futures before the market. And it raises a question of whether anything can shake a market that's flooded with central bank cash and where fiscal policymakers will step in as things deteriorate.
Yeah, Lisa, good morning, and thanks for having me. If 2020 taught us anything, it's separate the signal from the noise. On Wednesday, it'll be the 9-month anniversary from the lows on March 23rd. And Lisa, do you realize the S&P's up 65% from those lows? And over the past 12 months, U.S. equity funds, with latest data that we got last week from Morningstar, lost $225 billion in flows, and money markets gained $760 billion over the past 12 months. So investors are completely exhausted from the headlines. What we're looking at here, Lisa, and we would agree with you, there's resiliency here. The points that are the signals: narrow majority in government, a very committed, not just Fed, but G4 central bank policy. That fiscal policy that is actually the better stimulant right now than monetary policy. If you look at folks that make below $60,000, Lisa, their unemployment rate has gone up by 19% this year. They need fiscal stimulus. They don't need Operation Twist from the Fed. They need fiscal stimulus. But the true game changer is vaccine. This market will live and die next year by the progression of the vaccine. And that's the real signal that we're using for the reliability and resiliency of the global recovery.
Well, but Phil, let's unpack a bunch of this. What you were talking about, that fiscal stimulus is really what we need. And I think most people would agree with you that we need to bridge the gap between lower income individuals and higher income ones and some of the distress that we're seeing in the real world away from markets. But the question is whether this particular $900 billion package will actually stave off additional action, especially if Republicans maintain their majority in Senate, as many people feel. How pivotal is that to your market call next year that we do get an additional round of support?
So again, it really relies on the vaccine. I think the new information that policymakers have had is that November 9th announcement of the vaccine. And you know, depending on the rollout, that'll be how much fiscal stimulus that we need. But Lisa, what I think is really critical is that both sides gave a little bit on this. You know, the Republicans gave on the liability side for businesses, and the Democrats gave on the state and local aid. So I think this is exactly the stimulus that was needed at this point in time to bridge the gap between now and what we believe and what a lot of experts believe is an environment where if you want a vaccine, you will be able to get it by the second quarter of next year. And I think this is a great bridge towards that.
So, Phil, let's say that what you're saying is all accurate and we do get that vaccine and anyone who wants to get it can get it by the second quarter of next year. I hope you're right. Is that enough, though, to get markets to go higher? Because that's kind of the consensus right now. I mean, that's kind of what's being priced in.
Yeah, good question, Lisa. Everybody that's on your show is probably saying own stocks over bonds. Yep. So we agree. We agree that that's a consensus statement. The difference next year is going to be on the security selection and sector selection. So what does that mean? It means that within stocks, it's don't just own stocks over bonds. We have the highest allocation we've ever had to small cap right now. And we know that that's a risky position. So some of that is being held in just being long calls on the Russell 2000, which limits our limits our downside a little bit. And on the fixed income side, the big trade is still in credit versus government bonds. So, credit is not a trade that we think is going to have a tremendous amount of total return, but the yield that you're going to get in investment grade, high yield, crossover credit, which are credits that we think there could be rising stars next year if the recovery holds, as well as securitized or non-corporate credit is important. And finally, double index weighting in emerging market equity. That's the difference, Lisa, between just saying there's a recovery next year and own stocks over bonds and what we think is going to determine success versus failure. It's the sizing and it's the sector rotation.
So Jonathan Farrow, who is not here, but I'll channel him because this is his property, would call me Debbie Downer for this question.
You have to talk with a British accent, though, Lisa, to do that.
Yeah, I think I'll spare everybody on that one. But I will say, he would. I am wondering, is there no consequence to all of the debt that these companies have incurred? I mean, they've incurred record amounts of debt this year to plug the gap in customers, frankly. If you look at airlines, for example, doesn't that hamper their ability to recover and potentially even thrive and survive in the years ahead, even if the world does return to some sort of normalcy?
Yeah, I love this question, Lisa, and this is what I've always said. The 10-year Treasury is the straw that stirs the drink, okay? So you're going to get a lot of answers by the path of rates next year. And that debt becomes very, very expensive if we get a regime like we saw in the last cycle, where 10-year Treasuries trade between 2 and 3. Now, that doesn't happen in a vacuum. If rates do trade between 2 and 3%, Lisa, that comes with a lot of earnings next year, right? So that is a story that, can't just happen by itself. All of a sudden, debt becomes very unaffordable. We're in a sweet spot right now where we have 2017-like expectations for global growth with 2009-like policy, early cycle policy. So, Lisa, that question is yet to be determined. But with what we know now about what central banks are saying and QE policies, the debt that has been incurred is extremely affordable, whether it be the corporate balance sheet or the consumer balance sheet. And that's a great tailwind. In the last cycle, we think it'll be a tailwind this cycle.
Phil, have you already booked your airplane tickets for when COVID subsides?
I can't wait. I can't wait. Not yet though. But it is. I used to do 100 trips per year for business. I miss those days. So not yet, but it's coming, Lisa. I can't wait.
Are you guys back in the office yet or no?
So we are back in the office. Now the holidays are always slow, and Manhattan is great. I'm so glad to be back there. The Rockefeller Center tree looks great. Again, separate the signal from the noise. The noise was that it was a crooked tree, but it was a great-looking tree, Lisa. So it's good.
You heard it here, that the signal from the noise, the tree looks just fine. Phil Camporelli, thank you so much for joining us. Let's head back to the markets desk. Abigail Doolittle joining us with more. Abigail.
Well, it's hard to top that, Lisa, but we do have stocks off of the lows, so perhaps a little bit of encouragement there. The S&P 500 right now down about 0.8% relative to its session low, down 1.2%. Nonetheless, we have some real weakness for some of the sensitive stocks that are sensitive to the economy, such as the industrial metals. And actually, take a look at that. U.S. Steel now popping higher. All of these stocks, Alcoa, Freeport, McMoran, and U.S. Steel had been sharply lower in the pre-market. Now a little bit of a bid for U.S. Steel. So it seems that some traders are reassessing how risk-off do they want to be on the virus mutation, and also is this really a sell the news moment around stimulus being passed potentially by Congress. But if we take a look at retailers, we are going to see some of those stay-at-home fears because we have Macy's turning around too. So again, traders and investors are reassessing how bearish is this? Is this a true stay-at-home moment, or are we adapting and perhaps some of these retailers that were down so much in the pre-market, Lisa, won't be hit as bad as initially thought?
I got to say, Abigail, it's a buyable dip. I mean, that's basically what we're seeing. Everyone was saying, buy the dip, buy the dip. Well, we get a little bit of a dip. I guess people are buying. Coming up, we're going to be speaking with Mark Kiesel of PIMCO all about what we're seeing in credit. It has been an incredible rally. How much more does it have to go? That's next. This is Bloomberg.
se logra una sonrisa de parte de cada persona que utiliza el dispositivo, ya que se pone en situación, entre comillas, de una persona discapacitada. Y ven que lo sorteamos de una forma agradable, porque el simple hecho de sentarse en un dispositivo ya es agradable.
Nace más como una solución de movilidad a personas con discapacidad, nace Mandados como una opción de generación de ingresos y nace Mad Tools como generación de ingresos y educación a las demás personas que no están en silla.
Reversed some, but we're still lower on the day in the United States. We've also seen bonds in Germany, in the UK, falling, the yields rather falling, and we're seeing the dollar rise, the dollar headed for its biggest advance since June. So you could say the more things change, the more they stay the same. And that appears to be true for 2021 as well, at least according to forecasters at some of the biggest primary dealers. You look at what they figure is going to happen to the 10-year yield. They say between the beginning of the year and the end of 2021 will fluctuate between call it 0.9% and 1.5%. So still a very narrow yield, but higher than it was this year, above the range of 0.5% to 1% we've traded since the beginning of the pandemic. It is still well short of the 1.94% mark where it began this year. Remember that? We came into 2020 before COVID with a forecast range of roughly 1 to 2.25%. The 60 basis point forecast for 2021 is narrower than that, certainly by the standard of recent years. 100 basis point ranges have been sort of typical. Yields at every tenor during 2020 made record lows. The 10-year fell to 0.314 in March. Remember that. The 2-year yield currently close to about 12 basis points, we'll call it. Predicted, meanwhile, to end 2020 around 0.2 to 0.4. So where do you get yield? Well, the more things change, the more they stay the same. Did somebody just say that? The U.S. junk bond rally set to extend its CCC reign as the best performing asset high-yield debt 7 consecutive weeks. The CCC index rallied for 24 straight sessions. It's the longest winning streak since 2011. Issuance volume, almost $30 billion. That's the busiest December since at least 2006. General forecasts are that streak continues into January. But after January, I mean, we asked these people to make predictions, but after last year, I'm not sure they're going to want to be quoted on this come next December. We'll see.
Yeah, people are not very fond of prognosticating right now, but they continue to do so. Michael McKee, thank you so much. PIMCO's Mark Kiesel remaining constructive on risk assets, favoring exposure to some of the sectors hardest hit by the pandemic, including travel and tourism, saying credit markets remain supported by improving fundamentals and supportive technicals. We see continued upside in travel and tourism sectors. Mark joining us now. Mark, on a day like today, when there is a bit of a risk-off feel, and you actually have something of a dip, albeit a pretty minor one at this point, are you in there trying to find those airline, those hotel stocks, or rather bonds, to get in and try to add to risk?
Hi, Lisa. Good morning. Well, we are constructive, particularly over the medium to longer term. There's no question that near term, the virus is spiking and we are getting a little bit of a risk-off tone. But yes, we want to be selectively adding risk on these sell-offs because if you look at the next 6 to 12 months, we actually see a lot of stimulus in the system, both from monetary and fiscal policy globally. And we also see an economy picking up steam in 2021. So we expect double-digit corporate profit growth. And there's many areas of the market that have significantly underperformed in 2020 that we think actually will catch up next year. And so we are selectively adding risk into sell-offs.
Mark, is this just a bet that the Fed has the credit markets back no matter what?
Well, Lisa, if you look at global central banks throughout 2020, global central banks will have bought $8 trillion of assets. So this is really unprecedented, and that's not even counting the $3 trillion of government stimulus just in the U.S. with what is likely going to pass today. So the markets are being flooded with liquidity. Money market funds are sitting on $4.5 trillion, which in my estimate is at least $1 trillion too high. And then in addition, you've got significant money on the sidelines with private equity and corporate profits set to go up double digits. So the bottom line here is that central banks have markets back right now simply because there's no inflation. And so without inflation, you can expect the Fed and other central banks around the world to continue to support markets. And this only changes once you get inflation above 2%. And in the United States, that could take 2 years.
All right, Mark, but then there's a question of what happens when companies are zombie companies and perhaps aren't making enough money to cover even their interest payments, and yet the Fed's policies allow them just to keep borrowing more and more money. When does the time run out for them?
So, Lisa, what we've seen in 2020 is really something unprecedented. And really, the Fed and the government's policies disproportionately helped large cap companies. So there was significant differentiation. The large cap companies that were able to get money through the markets actually were able to term out their debt and raise significant liquidity. So some of these large cap companies, believe it or not, are sitting on 18 to 44 months of liquidity. There's no question that some of the smaller firms, the small cap companies, did not get that assistance, and frankly will face a rising bankruptcy threat. So 2020 really will go down in history as how COVID created significant winners and losers. What we've been focused on is the large cap companies, the companies that actually have built up a war chest of liquidity, and those companies that also see significant upside over the next 1 to 2 years if we ultimately get this vaccine to roll out and we get the global economy to recover.
There's a question, though, how much more returns are there? I mean, it's one thing to say that they're going to outperform, but I'm looking at CCC rated bonds. They've returned 11% since the end of October. That is less than 2 months performance. We are talking about corporate bonds, not stocks. How much more upside is there?
So we would really be more cautious on the CCCs. We're not really diving into the riskiest credits right now. The value we see is in some of these BBBs and the BBs, which actually have, again, 18 to 44 months of liquidity, so that as you get this rebound in travel, which realistically could take 6, 12 months, even 18 months, but as it occurs, these companies have significant operating leverage. So the bottom line, Lisa, is we want to stay higher quality. Those companies that have built up that war chest of liquidity, so own less CCCs, but own those BBs and those BBBs, which actually have significant liquidity cushions right now.
So that means that you say to people, you need to lower your returns expectations, right?
Absolutely. I think if you look